Yahoo Finance investors were polled and gave us some of their predictions for the markets into 2023. And then there were some intriguing ideas about who will make and lose money and what might be different by the end of next year. So here to break down some of those responses, we've got Yahoo Finance senior columnist Rick Newman. Take us into the Newmaverse and what we got in some of these responses.
Yeah, we got thousands of responses. So we've asked some basics about where do you think markets will be, where do you think inflation will be next year. Our audience expects modest improvements in the S&P and the NASDAQ, single-digit gains there. In general, our audience does think we're going to have a short and mild recession at the beginning of the year, but they're very optimistic about what the end of the year might bring. So in addition to just asking things like where do you think inflation is going to be, the stock indexes, we asked just an open-ended question, blank sheet of paper, fill in the blank. Tell us what do you think the big story, the big business and economic stories will be next year. And then I scanned through almost 4,000 of those to figure out some of the recurring themes. And I've got a couple of them for you here. So first of all, lots of our audience members think the second half of the year we're going to see a nice bounce in stock markets. We're going to be beyond whatever the little itty bitty recession is that comes at the beginning of 23, and inflation will be under control. So maybe around 4% or so, let's say. So that is a pretty good scenario for markets, I think, as long as it seems like we're finally going to get to the point where interest rate hikes aren't determining everything.
Rick, yeah, all that work paid off. This is now on the top 10 most viewed or looked at or read stories on Yahoo Finance right now. So hat tip to you, Rick.
Well, hat tip to our audience because they actually we have very smart readers,
yes,
and I like to know what's on their mind a lot of the times.
Where are they thinking about on tech stocks to that point? I mean, a lot of these viewers and investors on our platform, they log in, they check Apple, they check Amazon, Google. Yep. These are the only stocks they have historically owned, and they've all been battered this year. Yeah.
So another recurring theme in this open-ended two I'll give you here. So I've got 11 predictions I put together on a story that's on the site right now. But we do have a significant number of Yahoo Finance people who think big tech will make a comeback. The big tech play is not over, even though the NASDAQ has gotten hammered this year more than the broader stock market. But they say, look, Apple's dominance is not over, Microsoft's dominance is not over. And then one other prediction, we just had an investor telling us he's short Meta. I didn't hear him say he's short the metaverse. He said he's short Meta. But we have some audience members who say the metaverse is finally going to catch on in 2023. Now, I think it depends how you define metaverse. So I'm not sure you two guys are going to be wearing VR goggles at the desk here by the end of 2023.
Hold on, let me get mine from
maybe 2025. I don't know. Yeah. But I like what our investor said just in the prior segment. He said, the metaverse is not necessarily going to be this cartoonish idea where people are sitting around with these VR goggles and somehow they're in a conference room in Hong Kong. That it's going to have more to do with better ways to do social media and stuff like that. And that's actually what I saw in some of these comments, that social media is going to have problems, like look at what's happening to Twitter, right. And that's an opportunity for the metaverse to come in and offer something better.
As long as we're all not replaced by some artificial intelligence deepfake, then that's perfectly fine, I think.
I guess.
Careers.
I feel like it's coming, but hopefully not next year.
Let's keep that at bay for now. But when we think about next year and kind of bringing together where you continue to cover in what's happening inside the Beltway in Washington, D.C., and where that overlaps in terms of equity markets and just public policy relating to business practice as well. What did some of the readers kind of put together or at least correlate between?
Well, let me bring it back to inflation. Because we saw, in a way, the craziest inflation we saw this year was in used cars. Mm-hmm. First half of the year, we saw used car inflation as high as 40%. So one of the things that came through in all these open-ended comments was we're going to see the opposite, the mirror image effect in 2023, which is a plunge in used car prices. Perhaps back to where back to levels they were before all this craziness happened because of a new car shortage. So, Saj, you might get to add to your collection in 2023.
This only fuels the debate on our worst company of the year, which you covered, Rick.
Yeah, which was Carvana. Yes. And it's not so much because of what's happening in the used car market per se. Carvana got way too far over its skis, made an acquisition, took on too much debt, but also did not prepare for what could be a really sharp reversal in used car sales next year. So a buying opportunity. And then one last one I thought was really interesting. A lot of people think the electrical vehicle revolution, EVs, is overplayed. and that we're going to see the EV revolution stall. It's going to turn out that we're not going to go all the way to EVs as fast as people think. It's the fact that they tend to be expensive, limited range, and rising electricity prices, by the way.
So the return of the naturally aspirated V12.
Or sure. So that's what you're going to buy on Carvana is next year is a Bugatti V12. Okay, sure. That's where I was going with this.
There'll be plenty of them there for you.
But, look what's happening in Tesla stock to end the year. And we're seeing Lucid and Rivian, look at those stocks struggling. So we have a lot of investor-minded, investors using our site who are looking at all this and saying, maybe that's one of the things that's going to happen in 2023. The EV revolution stalls, at least for a period of time.
Well, great stuff, Rick Newman.
Yeah,
really
fun.
Appreciate it. Please do give Rick's story a big read here and a big share. Rick, appreciate it. Companies took a cautious approach to M&A this year, with good reason. Rising interest rates raised the cost of borrowing to less attractive levels. Potential targets became less sexy as growth rates slowed, and there has been a general black flag hanging over any deal in the form of a possible recession. So will 2023 be any different for deals? Emily Feldman, professor of management at the Wharton School, joins us now. Emily, good to see you. So how different will next year look, if anything?
Hi, good morning. Yeah, I think it's going to be quite similar, at least for the foreseeable future, right? I think at least through the first half, sort of given the environment, the uncertainty around where interest rates are going, the volatility in the stock market, geopolitical factors, it's sort of hard to see a quick change when the calendar turns. So from that perspective, I think we're in for more of the same, at least for a little while. Obviously, we'll see how things evolve in sort of the second half plus of the year, but that's at least my prediction for the short term.
What does that mean for SPACs? This is the entire kind of construct for how some companies were able to tap into the public markets. And it was really via the deal making that took place. A shell company that would go public, and then the de-SPAC and the acquisition of some smaller prospective company that was really kind of targeted as part of the shell company going public.
Yeah, it's an interesting question, and I think there's two factors, right? I think obviously the market conditions are affecting this, right? In terms of the attractiveness of this structure, right, of SPACs in general. But then also, as we're sort of seeing, sort of a tightening environment, perhaps for the entities that might be SPAC worthy in the first place, as things get more difficult from that perspective, that could also be a challenge from the input, right? There was just an article that was saying that this was the greatest unwind of SPACs that we've seen basically in 5-10 years, right? So I think from that perspective, it's a contributor as well to sort of the broader M&A market. But obviously, there's a big difference between sort of SPAC transactions versus sort of large corporate deal making that we typically think about.
And Emily, this year really, I would say, is the year of, or has been the one of divestitures. Kellogg, of course, going through their restructuring process. GE, we're talking about GE Healthcare getting ready to be spun off in early January. Will we see more of that next year, especially if we get a recession?
Absolutely. And I really think that this is actually the trend to look out for in the coming months, right? So yes, we've seen a ton of this activity already. And I would argue that that's not necessarily as much linked to sort of the macro environment and the conditions that we're facing. But now that things are tightening so much, right, I think we can expect to see this. And there's really two key drivers here, right? So one factor is, of course, the fact that liquidity is going to be much more constrained. And so divestitures can often be used as a source of liquidity for companies depending on how they're structured. So that's one big factor that should prompt more divestiture activity. But the other is, sort of a broader issue, which is that, when conditions tighten, the value of focus within organizations becomes even more significant. So you have a company that has a lot of different business units. What's your core? What's your strategy? Where are you investing your capital? Where are managers and executives spending their time and attention? What's really central to the company's strategy becomes a really critical question. And so one of the big reasons that divestitures are valuable is that they can help companies to achieve this focus that is especially important in this kind of environment. So for both of those reasons, right, the liquidity and the focus arguments, I would say that we should really be on the lookout for more of these transactions in the coming months here.
Valuable insights from someone who literally wrote the book on divestitures, Emily Feldman, professor of management over at the Wharton School. Thanks so much for taking the time here with us today, and early Happy New Year to you as well.
Same to you. Thank you so much.
Joining us now, we've got Michelle Connell, who's the Portia Capital Management owner. Michelle, great to have you here with us, and an early Happy New Year to you. A year that many investors want to put behind them in 2022, and now looking squarely at 2023. Where should we be finding some sources of perhaps optimism for 2023?
Well, first off, thanks for having me on, Brad, and Happy New Year to you and all investors. I'm still, despite the tape looking, a little bit more optimistic today, looking out at least through the first half, and definitely the first quarter, I'm still a little bit cautious here. I think we're going to be looking at more softness from a consumer, and that means that we're probably going to be looking at softness when companies come out and report first and second quarter, and you're going to see revenues probably down and margins taking a little bit of a hit here. So I think that we still have some tough waters in front of us, the beginning of the year at least.
Michelle, on the cautious part, where do you think the landmines are going to be this earnings season? What sector is really going to surprise investors negatively?
I think it will be the areas where consumers have the largest impact. That will be maybe even consumer staples, consumer discretionary. I think as you're seeing more people trying to keep up with inflation by tapping out their credit cards, we saw that at the end of the third quarter, a $40 billion increase. That's huge. And people are starting actually to tap, taking hardship withdrawals from their 401ks. And you look at all that combined, and also with how heavy portfolios have been hit, I think people are going to get through the Christmas and holiday season and open up, start looking at their investments and going, okay, what now? So I think people are going to take their time wading back in and taking risk. So consumer discretionary and consumer staples, I think you're going to see softness there. I still like energy, and I think bonds are a good area to start looking at. No, there's no harm in getting 7% in, some good, strong bond funds, and while you're waiting to take on more risk.
When your customers reach out to you and clients want to have a conversation about where they should stay invested right now, what have you been advising them?
I've been fortunate because it's an education process with your clients. You always are reaching out to them and telling them what's going on and where you are seeing some potential opportunities as well as risks. And clients want to know that they are protected from more downside at this point, and that they're going to be able to make their retirement goals especially. And so they want to make sure that what they've saved up to this point, there's not going to be any more damage. So talking them through the strategies, and also trying to steer them away from being more short-term focused, which all of us are as human beings, to more long-term focus and, the end game, what they want to accomplish.
When we think about the number of people who are set to retire in 2023, how does that really impact the equity markets as well, if they're starting to pull some of that off the table in order just to make sure that additionally, at least on the onset of retirement, that there is enough cushion for themselves?
You're having more individuals that are near retirement who are, wanting to go to more safety in their portfolios. Individuals either want to go towards more bonds or more real estate or even cash. So you can't blame them at this point. And you even have individuals, I've had people come back to me and say, do I have enough? Am I going to have to go back to work? These are individuals that are either retired or close to retirement. And so these are things that individual investors are really concerned about going forward. How are they going to meet these goals, especially if these goals are necessary in the near future?
Michelle Connell, Portia Capital Management owner. Good to see you. Have a Happy New Year.
And as we continue to count down the days to the new year, our next guest says a mild recession is coming in 2023. We're joined now, by Gus Fauché, who is the PNC Financial Services Group Chief Economist. Gus, I was putting all the green up on the screen, trying to tee us up for a really positive and bright conversation, but you're saying mild recession is coming in 2023. What gives?
Yeah, that's right. I mean, obviously, we've seen a big increase in both short-term and long-term interest rates throughout 2022. We're already seeing a significant contraction in the housing market. And I think we're going to see a greater drag on consumer spending on business investment from those higher rates. And that will lead to a mild recession, probably starting sometime in the spring. But it should be more similar to the recessions that we experienced in the early 1990s or the early years of this century, rather than either the Great Recession from 2007 to 2009 or the COVID recession.
Gus, is the housing market collapsing?
It is contracting very, very quickly. So we've seen housing starts. We've seen existing home sales fall by about 30%. We're starting to see house prices decline throughout the nation. I mean, that's not surprising given that the 30-year fixed rate mortgage went from below 3% in the fall of 2021 to up close to 7% now. Affordability is a big issue. This is what the Fed is trying to do. By raising interest rates, they're making it more expensive for potential home buyers to borrow. That slows economic activity, and the Fed is trying to cool off economic growth in the hopes that that will slow inflation.
Well, to that end, do you think we get an economic soft landing next year?
I think it's going to be very tough to achieve that. I think given the rapid increase that we've seen in rates, given the fact that inflation is still well above the Fed's 2% objective, we are seeing very strong services inflation right now. That's being driven by strong wage growth. And so the Fed needs the labor market to cool off. We really haven't seen that happen very much. So I think we see more interest rate increases from the Fed in early 2023. I think we see a further drag on interest rate sensitive industries. And I think by the time we get to the middle of the year, the economy will be in recession.
Okay, so what's a consumer to make of all this? I mean, we've been talking about a recession for what seems like already 7-8 months.
I want to talk about growth, Brad. I want to talk about growth.
Right. And so for consumers who have now mentally had to weather through the reality or the risk of a recession for 8 months until the end of the year, and then until it actually really hits at some point in 2023, what's the consumer mindset going to be like by the time it actually hits?
I think consumers are actually in fairly decent shape right now. Many consumers still have adequate savings given the stimulus programs and limited opportunities to spend during the pandemic. The job market is still very good. Wage growth is still very strong.
But aren't they taking on more debt right now?
Businesses are going to... I'm sorry?
Aren't they taking on more debt right now? Isn't that showing up in how they're spending? That's showing up in the credit card data that we're seeing come across. Clearly, they're looking for alternatives in their mechanisms of spending as opposed to some of that cash.
No, absolutely. But they're starting from a very good point. So although consumer credit quality has deteriorated somewhat, it's still very good. They still have a lot of savings, even though they have spent down some of that savings. And so I think that consumers are, pretty well positioned heading into a downturn this time around. Certainly much better than what we saw, for example, in 2007, 2008. The other thing is that I think businesses are going to be reluctant to lay workers off this time around, given the current tightness in the labor market, and they don't want to be stuck when the economy comes out of recession in late 2023 with not enough workers. So I think that job losses will be fairly limited, and that the downturn is going to be concentrated in housing and consumer spending on durable goods, and then business investment.
Gus, is this going to be the recession that most of us just won't feel? And I'm looking at, let's say, I go to a Starbucks right now, Gus. Over the last weekend, I was run over by 15-year-olds. The place was packed.
Yeah, no, absolutely. I mean, you were talking about the theme parks, for example, and people are still spending there. People haven't been spending. They haven't been going out because of the pandemic, so they're still spending there. I think that this should be a pretty mild recession. I think this is going to be more like the recession of 2000, 2001, or the recession of the early 1990s that is going to cause pain, particularly for people who are in housing-related industries, people who are in heavy manufacturing. But I think that many consumers will hardly feel this, to be honest with you.
All right, let's leave it there. PNC Chief Economist Gus Fauché, always good to see you. Happy New Year.
The Fed's fight against inflation yielding some visible results, but it is also setting up the market to anticipate a pivot earlier than expected. The lagging effects of rate rises plus sagging employment could mean a good outlook for markets, but maybe not for the economy. Joining us now with more, we've got Joshua Wine, who is the Hennessy Fund's Vice President and Portfolio Manager. Great to have you here with us this morning. Break down your thesis for us. Of course, we know that economy, markets, not the same thing, but both of them very much are in reaction to the Fed's policy pathway that is continued to be put forward here. Do you expect that we'll see any type of pause or a pivot in 2023?
Sure. Good to be with you. Good morning. Yeah, I think that, the last year has been, whether it's good economic news or bad economic news, the Fed was going to raise rates. We all knew that, and they did. They raised several times, 75 basis points, and now we're in a phase where it's 50 basis points. I think that the back half of 2023 will look a little bit more normal from the perspective of bad economic news could be good market news, to the extent that the Fed either pauses, pivots, maybe cuts at the end of the year if the economy indeed slows as much as many expect, and certainly I do as well.
Josh, what changes to the portfolio or portfolios have you made in the last week of the year?
We haven't made any changes. So we're incredibly disciplined by design. In the Hennessy Midcap 30 Fund, we are looking at earnings growth, valuation, stock price momentum. We have not made any changes of late. Continue to remain invested in energy, consumer discretionary stocks, industrials. No changes.
What happens to those stocks if there's a recession next year?
I think that it might not be bullish for their top line, their bottom line, but I think that the bigger picture isn't the next 12 months for any company in particular. I think it's more the outlook for interest rates and the effect it has on the present value of future cash flows. So I think that, I think the thesis behind, being bullish on the market largely is to some degree what you were all just talking about, which was Tesla and many other stocks that have taken it on the chin. And I think that kind of reversing of the wealth effect, we saw an incredible bubbling up in the economy around new home purchases and auto sales and the like. I think that largely reverses. Some of that is the decline in home prices, lower activity within residential real estate, and ultimately commercial real estate, which we'll see coming up as fewer people work in offices. And also just the market. The market's down anywhere from 10% on the Dow to 30% plus on the NASDAQ. And I think that perceived or real feeling of wealth that people have had has started to dissipate. So I think that, the economy slowing down is not a big stretch.
Next year, it seems like it's going to be a year where companies themselves need to tap some of their cash balances and perhaps quite considerably as they navigate whatever a recession does look like. And of course, they've already instituted some of the cost restructuring that they can right now. But what type of cash crunch do you think we may see across equity market companies as they begin to report next year and really get into the throes of a recession?
Yeah, that's a great point. I mean, I think that, broadly, the S&P 500, there's about just over $7 trillion in cash on the balance sheet of S&P 500 companies. I think looking through that number, because certainly some of that cash is the result of raising debt in the market or taking on loans. So net debt, is in good shape, especially when you contrast that with operating cash flow. So, this past year, you're looking at that relationship and it's quite strong. So, of course, operating cash flow could start to weaken in a recessionary environment. But I think the larger point is that it would have to weaken quite a bit for there to be any kind of liquidity issue or any kind of talk, real talk about companies struggling to make ends meet. Capital markets are still alive and well. I mean, we've had a lot less deal activity than in the past. And I would also say that, interest rates have backed up quite a bit, but, we're nowhere near a 1980s scenario where, people are paying double-digit interest rates on borrowing. So I think where we were was artificially low. I think things are starting to look a lot more normal now, notwithstanding an inverted yield curve and certainly, interest rates well below where inflation has been of late.
Given all the concerns out there, Josh, what sectors do you really hate?
Really hate? I can't say I hate anything. I mean, I think that, there are certainly names, I think large cap tech, it's hard to get a handle on earnings expectations. And so, with a name like Tesla, it is interesting that the multiple, the forward multiple is starting to look, somewhat normal and perhaps attractive. I think what is problematic for names like Tesla that have, come on the scene very quickly, and even to date don't have that much competition. It's just hard to get a handle on where the earnings would be next year and beyond. I think that there's not a lot of stability there. Same thing with kind of your classic social media type stocks or advertising revenue focused stocks. It's just hard to know what that looks like. The multiples are starting to look more attractive, but I have a hard time getting some clarity around where things might look.
You mentioned that you haven't made any significant changes to your portfolio over the last 2 or few weeks going into the end of the year and the start of 2023. But if there's one trade that you hope to be able to initiate and the factors that would set that up in 2023, what would that be?
I don't think there's one trade. I mean, I definitely would not want to be heavy in cash as the Fed starts to change their language and people start to see their way toward the idea of a Fed cut. I mean, one thing that is interesting about this rise in rates of late is that now the Fed has something to do if there's a legitimate recession, if there's a shock to the system. So, they might not, quantitatively ease, but certainly a rate cut is in the offing, maybe later in the year. In terms of a trade, I would put out just some names that kind of fly under the radar. Super Microcomputer, which is in our Hennessy Cornerstone Midcap 30 fund, trading about 8 times forward earnings. They are a distributor and manufacturer of servers and storage equipment for large corporations. Not terribly sexy, not very exciting. I don't hear anyone really talking about names like this, but I think Super Microcomputer is interesting. And then also in the commercial and industrial packaging space, Sunoco products. A nice about 3% dividend yield that's growing, 10 times forward earnings. Very stable business. Don't see, much that, makes this hard, kind of to hold on to for the long term. So I think that names like that, especially when, we get into a more normal kind of Fed environment, more normal inflationary environment, and cooler heads prevail, I think these names are set up for a nice run.
Yeah, I never heard of that. Super Micro. Good call out there. Josh, I'm going to spend my weekend checking in on that one. Joshua Wine, Hennessy Funds Vice President and Portfolio Manager. Have a happy new year. Appreciate it.
It has been a brutal year for the IPO market, with 2022 marking the slowest year on record since 2008. That's according to research from the University of Florida. And proceeds have fallen off a cliff, too, to the lowest level that we've seen in more than 30 years. Here to break it down, what exactly happened, what it signals for the new year, we want to bring in Jay Ritter, University of Florida finance professor and IPO expert. Jay, it's great to have you back here on Yahoo Finance. So the year-over-year decline has been pretty striking here for everyone that's been following the IPO market closely. I guess, what do you make of the huge drop that we have seen in activity this year?
Day has turned to night. Last year was the biggest boom in the IPO market since 2000, and things have fallen off a cliff this year. The stock market is down, but interest rates are up. But even more importantly, the valuations on growth companies collapsed, a major reset. And that affected lots of IPOs. Last year, that was one of the things driving the big activity. The high valuations a lot of the companies were able to get told them now's a great time to go public. And with this reset in valuations, lots of them said, well, we missed the window last year.
Well, I'm looking at one of your stats here. We had the lowest number of IPOs in 2022 in any year since 1979. That was another year of high inflation. That was during the Volcker Fed. We could say a lot about that. But just wondering, how much of this is because of the business cycle? And I guess the contrary, the flip side of that, do you expect once the Fed gets a handle on monetary policy, gets a handle on inflation, can we go back to the norm? What does that new norm look like?
Well, 2008 actually had fewer IPOs than this year, but actually more money was raised that year. The IPO market is not super sensitive to business cycles. For instance, in the last decade, about 30% of all of the IPOs have been biotech companies, and they're not going to have revenue for 5 or 10 years, if ever, from product sales. So that they're not very sensitive to business cycles. But the IPO market is quite sensitive to the ups and downs of the stock market. And that definitely was a major damper on the IPO market this year.
And Jay, what about the focus just from an investor perspective, or really from the big banks, just in terms of growth and profitability? That's what people are more focused on now, rather than the growth at all costs, which had been the strategy that had been working, I guess, at least from an investor's eyes over the past several years.
Yeah, last year in particular, 2021, the low interest rates led to a situation where investors were looking at growing companies that were losing money and not focusing on the short term. They were thinking about future potential profitability. But basically, investors got over-optimistic. There was just too much money chasing a lot of these companies, whether it was in public markets or especially in private markets. Venture capitalists just had so much money to throw at these companies, and that led to the escalation of valuations to unsustainable levels. It wasn't as bad as it was back in the internet bubble of 99 and 2000, but in retrospect, 2021 was approaching those levels in terms of the optimistic valuations being put on a lot of young, money-losing growth companies.
We saw this year almost the death knell of the SPAC market, that's special purpose acquisition companies. This was maybe a loophole, an area of the law where they could skirt certain requirements in terms of forward disclosures, or they were limited by the IPO market in terms of the forward disclosures they could make. And now that loophole has been closed. We haven't seen a lot of activity in SPACs, almost nothing this year. Wondering if that chapter is closed on this market or if you expect a resurgence.
Well, it's temporarily closed, but this year 101 mergers occurred where a private company did go public by merging with a SPAC, and that's the second largest number ever. Only the previous year, 2021, had seen more than that. But all of the trends are down. Way fewer SPAC IPOs went public this year. Lots of the SPACs that went public the last 2 years that had not found a deal yet or not completed a merger are instead liquidating. And in fact, this month, before some tax law changes, there's a rush to liquidate. Already 80 SPACs have said, we're giving money back to investors. We're giving up on trying to find a merger partner.
All right, we got to leave it there. But did you have one more? We're going to leave it there. Thank you for that, Jay Ritter. U.S. pending home sales fell in November, with contract signings declining in all 4 major regions, according to the latest data from National Association of Realtors. But with mortgage rates falling throughout December, is a housing market rebound coming in the new year? We're joined by Citus AMC Managing Director and former Fannie Mae executive Tim Rood to discuss. Tim, thank you for joining us here today. Your overall assessment of the U.S. housing market, it's been depressed this year. What's the outlook for the new year?
Yeah, well, good to see you all, and Happy New Year. So 2022, I think we often forget, came in like a lion king. I mean, we were crushing it on every level in terms of existing home sales, record low interest rates, record low originations, even near record for the last cycle, at least, existing new home construction. So, I mean, everything that we talk about, when you start hearing things that say are down, below, that's off of a trend that was incredibly high. So I think it's important that as we hear like, oh my God, month over month, so-and-so is down or that's down, it's really down just in terms of its trajectory. You're still going to end the year, both from an existing home standpoint and from a new home standpoint, fairly strong in the sense that you still had home price appreciation in both categories. The volume of each is down 30-odd% for existing homes. And then for new homes, it's down around 15 or 20%. But to your question, that leads to that flywheel going into 2023. What you're seeing now, the best leading indicator that we have is that mortgage originations for purchasing a house are down about 40% for the year, right? So we're ending at a low point, 40% lower than it was last year. You kick that into what would be pending home sales, which is the next leading indicator. It's down about 35%. So you can see you're heading into 2023 softer, and it's really up to really Jerome Powell, I would say, in large part right now. How's his hand? Is he feeling lucky? Are we feeling lucky because he's gambling with at least 20% of the population's capital right now?
So, Tim, 2023, lots of debate out there about whether or not it's going to be the great housing bust, how significantly the market is going to weaken. Is it safe to say that that won't happen? And then I guess going off of that, if it doesn't happen, in terms of the drop that we could see in home values, what does that more specifically look like heading into the new year?
It's a great question. Look, it's something everyone's trying to figure out. And I think the easy way to look at it is probably following the track of interest rates. If interest rates continue to start going back up towards, say, 7%, right now they're at, 6.5%. Seems to be that if they get closer to 7, that's when things really start to break down. As interest rates got back to the lower 6s, you saw far more buyer enthusiasm and energy. So if interest rates go up, this is that one track, you're going to ultimately see prices soften, and you're going to see the amount of inventory increase because there'll be fewer transactions. I don't take softening as a 15 to 20% collapse for a number of reasons we can go into later if you have time. But the other trajectory, which is really where places like Fannie Mae, Freddie Mac, the National Association of Realtors, people who are really in the know are saying, hey, look, we're seeing a trajectory that looks closer to 6%, 5.5% interest rates. If that were to happen, then you're going to have far lower amount of inventory because you're going to have more sales happening, and you're going to have property values are going to see much more sticky, and in some places of the country, particularly on the east, probably go up in 2023.
And when it comes to the supply of new home sales, where are we? Because it looks like there might have been a bit of overbuilding, but I think we're still at historically lower levels, at least in terms of the historical range. Can you update us on that?
Yeah, the problem is that it's certainly gone lower. Look, builders learned a lesson in the 1980s. They learned them in the mid-2000s, that when they get over their skis and they overbuild basically for anticipated demand, and then whatever the exogenous event is, the black swan event, they found themselves overcommitted with too much production, too much unfinished production, too much inventory, and quite frankly, a fair number of them ultimately go out of business. This time, however, as soon as they started seeing interest rates go up and demand go down, they pulled back. You saw permits drop by 70% this year, by the end of this year. So they pulled back. They're like, guys, let's just get rid of the stuff that we've got in the pipeline. Finish building it. Let's get out of this, put our hands in our pocket and see what 2023 has to bear. So don't expect the builders to bail us out of this predicament, I think, in 2023.
All right. We got to leave it there, but great information there. Tim Rood, thank you.
Let's also look ahead to the coming year for markets. China's reopening remains a big story as we close out 2022. This amid growing concern that rising inflation in the world's second biggest economy could impact Fed policy. And that much discussed pivot, here to discuss is Max Wasserman, who is the Miramar Capital co-founder, senior portfolio manager. Great to have you here with us today. You heard our last conversation and what to look out for in 2023. I mean, if there was one big theme that you put on 2023 going into the year, what would it be?
Thank you for having me here. Number one thing I look at is you have to know what you're investing in. We're more bottom up, so we're not trying to time this market. So I would say focus on good companies and good dividends. I mean, we're dividend investors. So I would pay less attention to the market indexes and more at the company level. People forget that the S&P 500 is a market cap weighted index, which has been for the last multiple years more of a NASDAQ 100 portfolio. So it's mainly technology. And your previous guest on the show was making comments about you could just throw a dart. Well, when there's no cost of capital, when interest rates are zero, you basically could throw a dart, and a rising tide lifts all ships, if you will. We look at it a little bit differently because the market environment's changed. I mean, the one-year treasury is 4.75%. And now the Fed is raising and worldwide tightening. I mean, the Bank of England, the European Central Bank has all raised interest rates. So we think it's going to be a tougher environment for earnings. It's going to be a tougher environment for technology and these high multiple stocks going forward.
Max, how do you identify value in tech at this point?
Well, again, we focus on dividend-oriented stocks. So we're looking at companies that are paying you growing dividends. We're looking for companies' top-line revenue, strong balance sheets, and market dominance. That being said, technology is not cheap. I mean, you're looking at the average they're great companies, the Microsofts, the Apples, which we have investments in. They're at 20, 21 times earnings, and you can afford to pay that when interest rates are zero. But as interest rates go up, those multiples contract, which is why we last year were telling our clients, underweight the large cap technology. You still can have exposure, but we saw a problem with the NASDAQ given rising interest rates. The multiples were way too high in this new environment.
So let's talk about what you do like then a little bit more, Max. You sent us 2 picks. One of them is Advanced Auto Parts, which certainly the valuation is not that of a tech stock, but it's also an industry that has been a little bit troubled given some of the turmoil that's gone on in autos. So what do you see for 2023 from that business?
For that business, you're looking at a company that traded at 12 times earnings, paying you over 4% dividend. They ran into a little trouble this year with the fact that their inventory was low, their inflation issue as supplies because they were sourcing out of Taiwan. And the dollar basically had a great appreciation, which is killing them. That being said, the business they're in isn't tremendous. The average age of a car is 12.2 years. Used cars cost anywhere from $800 to $1,000 a year for maintenance. And so we see the aftermarket auto replacement parts a great place to be. Now, it's going to take a while for them to get through the last quarter, which they disappointed. But we think at 12 times earning in a growing environment, if you look at a slowing economy, more people cannot afford new cars with higher interest rates. So they have to keep their cars even longer, and they have to keep them repairs. So we like an Advanced Auto Parts here. We also have an investment in General Parts Corporation, which owns the Napa centers. So, but with that part of the business, we still think are very strong and will be in a slowing economy.
All right, we'll leave it there. Max Wasserman, Miramar Capital co-founder and senior portfolio manager. We'll talk to you soon.
As we approach the year's end, we're taking stock of a tumultuous 12-month period that delivered a global energy crisis, a crypto implosion, and more Elon Musk headlines than you can shake a stick at. What's in store for 2023, you may ask? Now, here to discuss is Yahoo Finance's Miles Upland.
He knows everything. You know everything, don't you?
So where do we even begin?
Under Armour?
What's your S&P target?
2 more days, I'll get to that.
So we have seen some targets start to roll in. I mean, what's clearly on the docket as we get into, or at least have our sights set on 2023?
I mean, something I wrote about a couple weeks ago is that everybody's consensus forecast for next year is, well, first stocks go lower and then they eventually, I guess, go up to go flat, basically. And I know, Julie, you love talking about price targets. And I'm a lot more sympathetic to analysts than you are, just because, everyone has a job. Their job is to make a prediction, tell their clients, here's what we think is going to happen, here are the reasons why. And you as the client are free to base your model on that, disagree, et cetera, to make a market. The sell side is in the service industry. They're not actually in the prediction industry. They're just in the, here's our best guess at what we think can happen. And I feel like I've noticed last few years, everyone does the 3 scenarios, bull, base, bear.
Yes.
And no longer do you really have people saying, I think I know where stocks are going to be, in 12 months' time.
Listen, I'm not unsympathetic to people setting their targets. I get why they do it. I get that it's like part of the whole shtick, for lack of a better word.
It's their job.
It's their job to do it. And it's fun for us to talk about their targets and whether they got it right or wrong. And yes, they do change it during the year. I understand the utility of it. But to your point, I think direction makes more sense and is more relevant to investors than that specific finite number.
Yeah. Destination and the path.
Yes, something like that.
To use Jay Powell's framework.
Yeah, there you go.
Like
That's
that,
exactly something like that. And you, so when you're looking at your themes, investing matters, I guess, is the one that's most relevant to what we're talking about. What do you mean by that?
Well, what I mean is investing is actually serious business. And the way that we go, let's go back to 2021. You have the whole meme trade, and it's basically a joke. It's like any idiot could do this. And honestly, from summer 2020 until October 2021, I guess November, we were, first starting to roll over in 2021. Kind of felt like that, right? I mean, you go from Dave Portnoy picking stock tickers out of a basket, pretty much getting winners out of that. Everyone's getting rich in the stock market. Everyone's getting rich in crypto. We could talk about that in a second. And I think there was this sense coming out of a decade of the bull market, which was really driven by the West Coast, driven by VC thinking, driven by the top line size instead of the bottom line. And it said, all you need to do is find, we had multiple analysts on this show going back to 18, 19 who would say, well, all you need to really do is find the biggest TAM and pick someone who's going to grow into that TAM most aggressively, total addressable market. So find the biggest market, find the winner in the market. You can't go wrong. And I don't know, I'm looking at categories like food delivery, which is a pretty big market, and the winners in that market haven't exactly been winners for investors. And I think it's, it's a paradigm shift. It's cliche to say it, but it is very obviously a change in the investing environment, and one that moves from like everything's a joke, stocks only go up, to, well, I guess maybe this is a real business now.
You're also watching the VC community, Miles, and they've really had a really terrible year. Do they have a comeback year next year, especially where they could do some shopping, just given where valuations have been just hammered this year?
Well, I mean, the thing with the VC market is that they don't do shopping in the same way that someone who picks public equities can go do shopping. I mean, you are trying to work relationships. You're basically trying to do marketing. It's getting deal flow so that you can hopefully find the next Uber when it's in its seed, or you're doing its follow-on seed or whatever. And so I was looking at some data from PitchBook, which had, this is from 2021. This was the biggest winners of 2021 for VCs, companies that went public. Names in here include our friends at Coinbase, Rivian, Roblox, Robinhood, UiPath, Coupang. These are stocks that haven't exactly hit it out of the park, and these were the big wins from the VC community going back to last year. Now, someone can of course come and tell me that, if you invest in Series A, it doesn't matter that the company, let's take Robinhood, comes public, $40 billion valuation, $30 billion. Now it's 5, 10. So I mean, the stock's at $8, $9. So that can be a winner if you invested when they were worth $500 million, sure. But the whole point of the business is we find the best companies, we bring them public, we change the paradigm. And yes, Robinhood has certainly changed. They have forced Fidelity to change how they think about their customers, which is, not nothing. But this stock chart doesn't exactly scream value creation for shareholders. And so to your point, Saz, about going shopping, it's like, yeah, sure, you can go to Stanford's campus and go find a bunch of guys who want to start the next tech company. And maybe you end up with MongoDB or whatever, one of these big winners. But, that's not really like going shopping. That's just working relationships and trying to find deal flow. It's not like going saying, oh, I love Under Armour and I think they're going to triple. Or, go to PayPal or whatever.
To be clear, I'm not saying that.
I'm just saying.
And you're not saying it.
I'm not saying it. All these companies, you go through Cathie Wood's list, right?
Yes.
All the stocks are down 90% this year. One of them is going to triple next year. So there's an opportunity there for someone, but that's not really the game that VCs are playing.
Or that ETF is playing.
Yeah.
You would need to pick the one.
I know, we open up the whole...
yeah, but anyway.
I'm just saying, you could kind of throw a dart at Yahoo Finance and find stocks that are down 80% this year. Yeah. And, that's so good luck to everybody out there. That's my take on 2022.
2023.
I'll get you my price target on Friday.
Thanks so much. Miles Upland joining us here on set. We appreciate it. Markets hoping to shake off 2022's gloom, with investors looking to optimism in China's reopening and a less hawkish Fed. Joining us now with more, we've got John Stolfus, who is the Oppenheimer Chief Investment Strategist. John, great to have you here with us today. You look out into 2023 and you think about some of the things that we hope to leave behind in 2022. Which of those factors do you think will still loom large as we move into next year, though?
Well, thanks for having me on the show. Really, it's great to be here on Yahoo Finance. Would have to say, when we look at the picture here, the risks remain things like COVID, China policy towards COVID, issues related to Russia's incursion into Ukraine and how that will turn out. So when we consider that, we've got to think that with the Fed still in a rate hike cycle, plenty of uncertainty remains on the table. That said, we think a lot of this has been priced into the market this year. We'd have to suggest that indeed the market has been oversold, whether it's the NASDAQ, whether it's the S&P 500 or the small caps. So we would have to think that next year, the 2023, is likely to be a better year. I think the Fed's going to keep raising. Okay, but we think the adjustments will be modest. We're not looking for a pivot. We're not looking for a pause, at least through the first quarter into the second quarter. But we do think that companies have shown that they can be highly resilient in challenging markets since the financial crisis, through the pandemic, and thus far in these rallies that we see.
Hey, John, it's Julie here. You tend to be, I would say, more optimistic of the folks that we talk to. And I'm curious, as you look ahead to next year, since you're already looking at a less worst year, not like gangbusters, but less worse, what could go even better, right? And you list some of these upside risks in your look ahead note, but what to you is potentially the most likely, the thing that you'll be watching most closely?
Well, I would have to say that the consumer will likely prove to be more resilient as there's still, based on the JOLTS index, plenty of jobs for those who are unemployed to consider at the very least. And in the meantime, consumers are keeping spending, even though they're relying more on credit cards. The reality is that the consumer remain, whether it's for, for experiential joy or for buying things, the American consumer remains positive related to spending, and I think has a fairly realistic view in terms of inflation. I also think that the Fed will once again be proven to be successful ultimately. It's prone to make mistakes, but ultimately the Fed is the arbiter in terms of setting interest rates via its benchmark rate. Monetary policy is, you can see it in those housing numbers that we saw earlier this week, and the numbers today that you were just talking about. They're beginning to have a genuine effect on this inflation that has been at 40-year highs.
John, if we get stagflation next year and no recession, does the S&P 500, let's single that out, recoup all its losses from this year and perhaps even more?
Well, it's the stagflation question is when we'll have to see what happens with the job market in terms of how that really comes out. But based on what we've seen over the last 15, 20 years, and even longer, we publish within our weekly piece and our monthly chart book the effects on the S&P 500's performance of interest rates, not only market interest rates, but also Fed policy. We'd have to think that there's a real good chance that we are going to see at least somewhat of what we would call a do-over year. I don't know if it's going to look like 2019. Remember, in 2018, the Bears ruled in the fourth quarter. They thought first quarter was going to be terrible. Boy, were they wrong. And the markets came back powerfully that year through the whole year. So we think you have to be, if anything, we think upside risk is probably greater than downside risk here. The biggest problem for the Bears is they tend to project whatever is negative today, they project it forward into infinity. And, the world and cycles are what they are. Things can change. Who would ever thought that President Xi would cut out the zero COVID policy so fast? How long that lasts, well, of course, that's up to President Xi.
So, John, all these factors considered, what's your top idea for 2023? What is the area that, for investors, they've heard about how defensive they needed to be in 2022 and 2023? Where would you say that they should perhaps kind of pivot their attention to?
The overcall still remains buy growthier value and garpier growth. So we like, when it comes to technology, and we think tech has been grossly abused this year, you want to own those companies that are deep, their services or their products are deeply embedded in the lives of both business as well as the consumer. A lot of those stocks are deeply on sale, and some of them even pay dividends, modest dividends, and sometimes even better dividends. We continue to like chips. Last I looked, the chips were still doing well from the October 12th lows. Up double digits. I think about 12% is what I recall off the top of my head. Last I checked my screen this morning, and would have to say you want to own consumer discretionary. Don't bet against the U.S. consumer. When times are flush, they spend like sailors on leave after a long tour of duty at sea. But when times are tough, the American consumer validates their work and their existence by shopping. They'll just move to private label goods, discount stores, or what have you. And so we think, look at the consumer, technology, and of course we continue. We've been adding for years now exposure to industrials. The industrial sector looks like a great place to be, not only from a defense position, but also power generation, as well as aerospace, both commercial and defense. And we have to think that with most of home appliances now connected to, or many connected to the Internet of Things, that it's a good space to be in. And financials still looking very cheap here. If we can get away from all this fear about the pending recession that everybody is certain about, we can probably see the financials have another period of a nice bounce.
John, just real quickly here, where do you stand on the great bond comeback of 2023 that everybody seems to be talking about?
Julie, I think this is central to it. That what all the fuss and muss about this that happened this year was it was the end of free money, is what the Fed was saying. We had easy money during the financial crisis, and coming out of it, we went to free money in the pandemic. That's not good. Bond issuers are beginning to pay for the privilege of borrowing money, giving something to bond buyers for the risks they take related to credit, callability, and the default risk. And so we've got to say, I don't know if it's a 60-40 play, but maybe a 70-30, 70-25 with fixed income, at the very least, a 15 to 18% exposure in a model that we follow.
John, always great to catch up with you. Happy New Year to you. Good to talk outlook with you. John Stolfus is Oppenheimer Chief Investment Strategist. Thanks.
Thank you.
All right, as 2022 comes to a close, we are focusing in on some 2023 forecasts that we've heard from Wall Street this year.
We are expecting an economic slowdown, and with that slowdown, we're expecting inflation to also come down.
Pretty much everyone is expecting a recession.
Right now, the labor market doesn't look like it's on the verge of a recession. In fact, it looks like a market that still needs people to come off the sidelines.
We do think the peak in inflation is behind us, but inflation is likely to remain elevated into the first half of next year.
Any acceleration in 2023 from this year is going to be quite grudging, and it's just not going to be broad-based.
We think that they'll probably start cutting rates in December of next year.
So there's a lot that people sort of disagree on going into this year. When will the Fed start to slow down? How much will the economy actually slow down? But directionally, there's an enormous amount of agreement, right? Inflation's going to start to decelerate, and we are going to see the economy really decelerate as well as the Fed interest rate increases start to bite. I took a look back at the end of 2021 to see what the predictions were like for this year. I wrote about it in today's morning brief. You always get strategists like making their forecasts, then they adjust throughout the year. But the forecasts that they make going into a new year, they tend to not be spot on, of course. And so now as we look ahead to 2023 and you look at the forecast, I think the median forecast is somewhere around 4,000 for the S&P 500 is what we're looking at now. 4,009 is the average here. So we'll see where we actually end up. An anemic increase is what most strategists are looking for.
Yeah, I think if there are two things in terms of where the Fed is going to be focusing or continuing to focus its attention and taking it from that perspective of their dual mandate and looking at employment and then looking at pricing. On prices and price stability, it's really a matter of where you see the stickiest areas of inflation within prices starting to retrace a bit. And that's around necessities. That's everything from what you're paying to fill up the gas tank, but also what you're paying on your electricity, what you're paying just in your housing. And so with all of that, it's going to be the continued deceleration in price increases there, and then the retracement, hopefully, of some of those prices as well, so that consumers can feel a tad bit better, at least year over year. But we're going to have to see a trend lock in place there. And in unemployment, they've said that, look, they're willing to, or at least expecting to see unemployment and the unemployment rate tick up, as a recession is a very real kind of inevitability that many economists that we've discussed, as you saw through that clip, had pointed out. And so within those dual mandates that the Fed does have, I think those are the two key areas that the market, within any data that we continue to get, is going to latch onto, just looking for a trend. And what that trend is, whether it's 3 months or 5 months, that's exactly where we could see some actual reaction from the equity markets here too.
Yeah, two things come to mind listening to those comments. One, all of that is super sad and depressing. And, it just makes me sad and depressed. It's a Wednesday. It's a holiday season. Number two, is it time to empty out my savings account and go all falling on stocks. I mean, this is one of the most well-telegraphed recessions we may or may not get next year. You have the S&P down, close to 20% this year. You have Tesla down 70% and getting hammered. We know all these things are coming. And you know that proverbial saying on Wall Street, do stocks climb? Stocks often climb a wall of worry. Is that what we might see coming out of the gate next year when we don't get a recession?
Yeah, that's a big question going into next year, and a lot of people trying to position their portfolio aptly going into 2023.
After getting a bad rap over the last decade, hedge funds seeming to redeem themselves this year. Several in the industry reporting major gains so far this year. Yahoo Finance's Alexandra Semenova joins us now with more. And Alex, I guess some of these hedge funds really capitalizing on the changing market conditions that we have certainly seen throughout the year.
Exactly, Shauna. The hedge funds have been scrutinized over the past decade, and rightfully so, because performance has been lackluster and they charge some of the highest fees in the investment business. Just taking a look at last year's performance, hedge funds returned an annual 10.3% according to the Hedge Fund Research Weighted Composite Index. Meanwhile, the S&P 500 returned about 27%. And sure, different hedge funds employ different strategies, so it's not necessarily fair to compare them this way. But when you're looking at the industry broadly and seeing that unmanaged regular stock indexes are outperforming the industry when they're charging such high fees, that's really not a good look. But this year, however, did mark somewhat of a reputational turning point for the industry. Citadel was among this year's standouts. It's on pace for its most profitable year ever. As of November, its Wellington fund is reportedly up 32% year to date. Around that time, the S&P 500 was down 14%, now down even more. And Citadel performance was so good that Ken Griffin actually took his employees to Disney World. He paid for 10,000
sign of a good year.
His employees and their families for a three-day trip to Disney World. And then you have others like the D.E. Shaw Group, Millennium Management, all set for double-digit returns. And another point to make here is the Texas Teachers Retirement System actually performed much better than some of its pension fears because of its hedge fund allocation. So it was able to offset some of the losses in its stock and bond portfolios. Now, to be sure, it wasn't all good. You know, there were a lot of hedge funds that did severely underperform. You have Tiger Global Management, which bet heavily on tech stocks, down more than 50% year to date. Melvin Capital completely shutting its doors. A lot of others that didn't do as well as Citadel and some of the good ones. But the point here is that this year's market drawdowns and the unexpected geopolitical risks that we've seen have really helped hedge funds reassert their place in investors' portfolios during a really challenging year.
So I know Coldplay played at that Citadel party. I heard about that. But what does this mean sort of for the industry going forward? People looking at how can I trade like a hedge fund? I mean, can you? I don't think you can. But where does the industry go now after such a banner year in 2022?
Yeah, so the struggle for hedge funds really started after the global financial crisis. We've seen a period of really easy money policies, stocks generally on an uptrend, and investors doing quite well. This really limited dispersion in the equity market, which is the range of possible outcomes for an individual investment. And now that we're seeing the Fed tighten conditions, and we're not expecting the bull markets that we've gotten in the past, hedge funds may really play a role in investors' portfolios going forward. Warren Buffett in 2007 famously bet that over the 10-year period ahead, the S&P 500 could outperform hedge funds, and he was right. If he made that bet over the past 10 years, he'd still be right. But over the next 10 years, might not be the case. We're probably not going to get the type of bull markets that we've seen with higher rates ahead, concerns about growth, geopolitical tension still high. So hedge funds might be, shining bright coming ahead.
Well, I could hedge my checking account at some point. Anyway, Alexandra Semenova, thanks so much.
Let's continue our conversation now on what to expect in the coming year of 2023. The Fed set to pivot away from hawkishness next year, but the turn in policy comes as the market finds itself in a very different place from the staggering growth we saw in the decade starting in 2010. Here with more is Michael Antonelli, Baird Managing Director and Market Strategist. And Michael, you're stepping out in front of it, I guess, and offering some predictions. Always risky, as we know, but they are important to do and also can be fun to do. So your first prediction for the next year does have to do with the Fed and its timing. Talk me through what you expect.
Yeah, definitely going out on a limb here. Predictions are part of a strategist's job, but ultimately, just trying to make really good guesses, trying to make really good probabilistic views. So I think the Fed's done hiking at the next meeting. This is a little bit out of a little bit out of consensus. I think they're done at the next meeting. That would be the Feb 1 meeting. I think they're going to end at 450 to 475. I think that's where they'll end. We're at 425 to 4.5 right now. So that's a 25 basis point hike. And I think we get one more CPI report. I think that will be enough for them to say, okay, we need to see what the effects are of these hikes. So that's my first kind of prediction for next year is that one more CPI report, one more Fed hike, and then they hit the pause button.
All right, Michael, by the way, great to see you here. Got to get to prediction number 2, and this has to do with yields and inflation. Now, a lot of analysts for over the last month or two been tripping over themselves to declare the end of the bout of inflation, say it's going to come down precipitously. Some not so much, thinking that they'll fall fast. But if inflation does fall, what happens to yields? Because I think that's the crucial differentiator here.
Right. So my second prediction kind of goes around yields and inflation. I do think inflation falls. I think it continues to fall for all the reasons that we've already seen it falling. Auto prices, commodity prices, oil prices. Remember, shelter lags will start to get that shelter decline next year. So that's when inflation, I think, really starts to fall. I think yields stay high, which is that I don't think as inflation falls, we see yields just go down with it. I think what you're going to see is yields kind of stay higher. And that's a good investment thesis, I think, for individuals next year. So look into the bond market. Is there anything I'm missing from the bond market? And if I'm right and yields stay high and that kind of 2010s mindset of low yields doesn't come back, then, FANG stocks aren't all that interesting either, right? Now you're looking at those tech stocks and saying, maybe I can't hide out in those and just wait for the market to go higher. I think exploring the bond world will be my second prediction next year. I think a lot more people will be doing that.
Yeah, certainly a lot of people have been talking about that, Mike. The other thing that you're looking for is gains in stocks in 2023. You're not alone there. The average forecast I'm looking at is about 4,009 for strategists surveyed by Bloomberg. So a gain, but another sort of meh year expected.
So the stock market, it's very rare for it to go back-to-back negative. Very, very rare. It's only happened a couple times since the end of World War II. It didn't happen after 07, right? 07 was a terrible, terrible year, and it didn't happen after then. So I'm playing the odds here. The odds of any given year being positive are about 78, 74, 75%. So I'm playing that. I do think that, again, the stock market's all about, are things getting better? Are things getting worse? I think they will get slightly better next year. I don't think we get any big gains, but I do think next year will be somewhat positive. And again, that is almost playing the odds more than anything. It's not really playing a macro theme. It's playing a theme that it's very rare for the stock market to be negative 2 years in a row.
All right, Michael, before you go, and we got time for one more here, where do you see the best opportunities for the new year? Any particular styles, sectors you're liking based on the setup right now?
I still like defense. I think defense is a great sector that's got tailwinds to it that are kind of geopolitical, that aren't necessarily about rates or yields or anything like that. And I also do like housing to come back. Housing is one of those things that you might say, why would you do housing when rates are high? There's just kind of a real endless demand for housing, and we're going to have to meet that in this country. So I would stick with housing, and defense would be my two for next year.
All right. Really appreciate you stopping by here. Michael Antonelli, Baird Managing Director, Market Strategist. Thank you.
As we continue to count down to the new year and look toward 2023, we welcome in our first guest this morning. Says the themes of inflation and recession will be sticking with us well into the coming year. Joining us now is Sylvia Jablonski, Defiance ETF CEO and CIO. Sylvia, good morning. It's good to see you. Happy holidays. Not a very happy holiday message, I guess, that we're going to be dealing with all this stuff going into 2023, right? But it does seem like, especially on the inflation front, that things are at least getting better or getting less bad. What are going to be the implications for the markets in early 2023?
Hi, Julie. Great to see you again, and thank you for having me. Well, look, it's not actually all bad news. I think that, where we're at today is probably where we're going to be in a couple of months, right? We have a Fed that remains hawkish. He wants to get to that 5% plus terminal rate. We'll see if he actually gets there, because a lot of the work that the Fed has done, hasn't really impacted the economy just yet. There's a little bit of a lag to that, as there is to job numbers and some of the data that they look at. So who knows? But let's take them for their word and assume that it's going to be a couple of rough months to start the year. But the good news is that inflation has fallen from a peak of 9.1% to 7.1%. It's trending lower. You're starting to see some softness in the housing market. So you do see this rolling recession that's actually happening out there. Consumer sentiment is terrible. Retail spending, although the consumer is resilient and starting to give a little bit, So a lot of this tells us that the Fed might not have to do as much as he says. And I think that on the other hand, though, if we have a recession, it's likely to be a soft landing because although the numbers are softening, they remain resilient, whether it's production, the consumer, and otherwise. But the good news is, sort of the spin on this is, every single time a market falls 3 to 5%, if you're a young person or if you're someone who has a retirement account and you're not retiring for another decade or so, these are great times to gather up stocks and create some value. So it's not all bad.
Well, let's talk about some of the areas where you might be seeing some opportunities in early 2023. I'm looking at your list here, travel stocks and some defensive names. Could you go into a little bit more detail there?
Yeah, sure. So I think when I think about 2023, the first half of the year, just based on, what I mentioned before, will probably be a little bit defensive. So I'll look at things like healthcare. A lot of these companies pay dividends. There's a massive aging baby boomer population. They're going to continue to consume medical services, pharma, biotech, things like that. And they tend to do well in recessions anyway. You're not any less sick if the market pulls back, right? In terms of the travel trade, it's sort of counterintuitive because if we go into a recession, perhaps, people might not spend as much. But I do think we're talking 2023. If you look at the outlooks and the last earnings calls from companies like Delta, for example, and Norwegian, they're talking about doubling their revenues for the next year. They're talking about increased demand. So you sort of already have that information from them. And you know that the next quarter or two might be okay there. I also like alternative energy. We're talking a lot about diversification. We're talking about looking at commodities that have done well. And when you look at a space like hydrogen, for example, it's a growing area that is actually picking up some steam. So you have these companies that are building out major hydrogen, plant cell stations. We're talking about Bank of America by 2050 saying it's an $11 trillion marketplace. The Renewable Energy Agency saying that 12% of our electricity will come from hydrogen. Right now, that number is 0. So these are areas where I'm going to look to allocate next year.
I want to pick up on hydrogen. I have to admit, for people who saw Glass Onion, perhaps over the holiday weekend, there was a little bit of a hydrogen theme in there, although it wasn't necessarily a positive one. I won't go further for fear of spoilers. But what I will say is that it may get to that size by 2050, but it still feels pretty early in that space. So what do investors need to keep in mind? I mean, these past couple of years saw a burning of investors who were trying to get in on disruptive technologies. And so what do they need to keep in mind when they're investing in spaces like this?
Yeah, so that's a great point. And I think, when we think about disruptive technologies, we're still thinking about companies that are around today and generating revenues, right? So while I believe that quantum computing is going to be, a massive innovation in the next decade, the companies that are just starting out in that space are companies like Google and IBM that are going to benefit from their existing business lines while they innovate, right? So it's not so much, think about the small company that's going to be, absolutely whacked by interest rates. That's sort of not what we're looking at. In terms of hydrogen, it's the same thing. It's companies like Fuel and Ballard and Plug, that have these massive contracts with Amazon to run their forklifts and things like that. But to answer your question a little more specifically, I think if you're looking at true, disruptive technology of like startups that are just on the map, perhaps just have gone public, not a lot of liquidity, I mean, they are absolutely going to suffer for the next couple of years. There's no doubt about it. They need to borrow and interest rates are going to be high. But if you're talking about innovation and disruption, with companies that already exist, are quality companies, sizable market caps, the IBMs, Microsofts, Googles, Amazons of the world. I mean, for those companies, I would argue, are absolutely on sale. And, you gave some great stats before about how long it took them to kind of recoup their performance. I don't think it's going to be 2 or 3 years. I think that this is going to be, the end of 2023 when you start seeing some of these companies start to recover because they're just too good. I mean, they have too much cash and they're part of every single thing we do in our day-to-day lives.
All right, some uplifting, an uplifting tone there, I would say, overall. And thanks for that. Thanks for being with us on a Tuesday morning here. Really appreciate you stopping by, Jared. As always, Sylvia Jablonski. November new home sales released this morning, showing a slight uptick in sales compared to October, up 5.8%, but down 15.3% compared to November of 2021. Supporting the monthly uptick, mortgage rates did fall recently over 6 consecutive weeks, according to Freddie Mac, now sitting at 6.27% and for a 30-year mortgage. What can we expect for this market in 2023? We need to bring in our next guest to get his perspective. Ben Miller, Fundrise co-founder and CEO. Ben, how are you viewing this latest downtick in mortgage rates? Does this have any lasting support for the market? And just wondering what your fundamental drivers are right now.
Yeah, I think we're getting close to the bottom in the credit markets. So what happened was interest rates and credit markets really drove down the housing prices. They drove down housing prices because mortgages and interest rates became so expensive. And now that you see the 30-year Treasury, the 10-year Treasury, all mortgage rates basically falling and spreads falling as well. I mean, like the spreads are tightening. I think we're going to cycle into the capital markets opening up in Q1, and that will restart the housing market in probably late 2Q is what my expectation is.
Where do you think rates will kind of settle in, let's say middle of next year? And to your point, do you think that'll be enough to get buyers, sellers, and investors off the sideline? At what point do rates get people back in?
Yeah, I mean, I think it's sooner than people might expect. We work across the United States. We own 20,000 residential units. We're buying thousands of units across every quarter. And we're seeing already an inflection point in the last couple of weeks. We work with 8 of the top 15 biggest home builders in the country. We're seeing a bottom in new home construction pricing. So I think it's going to surprise people. The way things move these days, everything was faster than it ever did before. And so I think mortgage rates, I mean, eventually they end up in the low 5s. That's where, today let's say Treasuries are going to be 3% long-term Treasury, 175 bips above that. It's going to be around 5. And I think that is very healthy for the market.
We were just showing some of your top primary markets on the screen there. Wondering if you could go break down some of the trends that you're seeing with regard to some of these regions and maybe add on some of the secondary markets too that you're tracking.
Yeah, the funny thing about real estate's a levered investment on GDP. So you lever the country's growth, the state's growth, the city's growth, and the neighborhood. And so those cities listed there essentially make up 1 million people a year of population growth. Last year, Texas, Florida, North Carolina, South Carolina, those 4 states grew 1 million people in 1 year, and the whole country only grew 1.3 million people. So it's something like 75% of population growth happened in a very few number of states, and in those states, it happened in 8 cities. So 8 cities are making up probably 65% of all the growth in the country. And so you want to be investing in those cities, and then you want to be investing in the best neighborhoods in those cities. And then you're just getting, most of the United States' growth in a concentrated geography.
Yeah, Ben, it's remarkable, the dominance of the southeastern region, in particular North and South Carolina, on everyone's top 10 list for next year. You talk about regions there. What about sectors that you think are sure to boom in 23?
Well, I got to say sure, because at the beginning of this year, Ukraine war happened. So but I would say that residential is, I think by the end of Q1, Q2, approximately, we're going to have seen the bottom, and residential is going to make a roaring turn back sometime mid next year. And industrial, I mean, the winners keep on winning. That's the nature of tech, that's the nature of real estate. The best markets and the best assets keep winning. And then office and retail are going to just continue to decline. I mean, we have a generational decline or obsolescence in essentially half of the real estate market, which is office and retail.
That's really interesting. I like these generational trends. They kind of play out over the secular time frame, maybe over a decade or more. Just wondering, how do you see the inventory situation right now with respect to satisfying the demand by millennials and now Gen Zs, forming new families in that trend, and how that may evolve in the coming decade?
Yeah, generational trends, that's exactly the right way to think about it, because if you take industrial in the 80s was like, not a hot part of the economy. And then e-commerce really transformed it. And e-commerce has been a generational change in how people shop, how people think about commerce. And the same thing's happening with residential. Work from home revolution is changing the way people live and work. And it's accruing to the benefit of single family housing most of all. And so you're talking about $1 trillion of office value being transferred to residential rental real estate, probably mostly. And that's like a 10, 15, 20-year trend. And I think it's going to be the biggest thing happening in real estate this decade.
All right. We're going to have to look out for that. Really appreciate your time here. Ben Miller.
Rising costs, debt-ridden balance sheets, and a renewed focus on profitability weighed on the embattled media sector as investors quickly punished companies struggling to turn a profit. Yahoo Finance's Alexandra Cannell joins us now with the breakdown.
Thanks, Saz. It's been a wild ride for media companies this year. Netflix down 50%. Disney and Paramount Global, same story there, down roughly 45%. But that's nothing compared to Roku, which has dropped 80% on the year, with Warner Brothers Discovery and Spotify sinking more than 60%. In this year alone, the stock market wiped a whopping $500 billion plus off of the market caps of major media giants, with more pain expected in 2023. So how do we get here, and what could happen next? Let's start at the very beginning. 2022, post-COVID, post-stay-at-home trade, and we saw subscriber growth levels slow. Netflix lost users 2 quarters in a row during the first half of the year, while NBC's Peacock saw zero growth at all in the second quarter. So amid that slowdown, coupled with those declines seen in linear television and a shaky macro environment, investors shifted focus to profitability. Are you a business that can make money? As a result, we saw mass amounts of layoffs, hiring freezes, massive restructuring efforts. And remember, these companies were spending tens of billions of dollars a year on just content alone. So it was a huge transition. But despite it all, there were some bright spots in 2022. Number one being ad-supported. Netflix and Disney rolled out their respective ad tiers towards the end of this year. A lot of optimism on the street when it comes to how advertising can help add incremental revenue and help hedge against churn, especially as competition intensifies. So that's something to look out for in 2023. Another highlight was that studios regained confidence in the box office. We had some record-breaking movies this year. Top Gun: Maverick smashing a 15-year-old record, by far the top movie of the year. And then those Marvel films like Wakanda Forever, Doctor Strange also killed it, easily nabbing 100 million plus openers. And even though Avatar 2 did miss expectations, industry executives still say the film will outperform and continue to add box office dollars throughout the holiday season and into 2023. So theatrical, not fully back to those pre-pandemic levels, but not as pessimistic as things seem to be in 2021. And then finally, another thing to watch will be more media mergers and acquisitions. As profitability is pressured, M&A is often the go-to solution. There's lots of talk on the street that Paramount could be unloaded. Disney, what will Bob Iger do with ESPN and Hulu? And what about WBD? Could that be a potential acquisition target down the line? So there will be assets for sale. It's a direct result of this soul-searching moment for the industry. In 2023, it's going to be a year of tough decisions. And I think it's safe to say not every media company is going to survive that.
Well, I guess we'll see what that means for this coming year. That was Yahoo Finance's Alec, and now breaking down the year in media. We'll be watching to see what 2023, of course, holds for the industry.
Well, as we wind down this turbulent year in the markets, our next guest emphasizes downside risk in 2023, driven by significant looming risks, including another hit to corporate profits, stickier inflation, and of course, issues with the Fed's pivot. Let's bring in Dana Dioria, Investment PMC Co-Chief Investment Officer. Good to see you. So as we look at some of these downside risks, obviously some were black swan events we couldn't predict, like Russia's invasion of Ukraine. But what is going to carry over into 2023?
Hi, thanks so much for having me. Yes, I think unfortunately a fair amount of what we're looking at right now is on the tap for next year as well. Certainly for the first half of the year, we've encountered a period of time where the market seems intent on expectations of a Fed pivot. I think we're finally getting to the point where the market is a little bit more wary and cautious around that. My expectation, just looking at the information, is that maybe second half of the year, but I think the Fed has been pretty clear. They've been very consistent about the fact that they don't want to have stop and go policy. We've seen, in the past that does not work well. The employment market remains strong. Another jobless report coming in, just confirming this. Wages remain sticky. It's the piece of inflation that's really kind of really staying high and sticky. So I do think that, the risk that we've had the second half of this year continue on into the first half of next year for sure. Top of the list. We have to continue to fight inflation, even as a lot of it is peaking, and the Fed will continue to do that.
And we have seen investors at some points getting a bit ahead of themselves with every sort of data point that comes out. But you say it's possible that the Fed pivot doesn't materialize in the way that the market expects. How so?
Well, I think, I think the market has been expecting maybe terminal rate lower than 5, maybe even January, we're not seeing an increase. And I just don't think that that's going to be the case. I do think that we continue to see increases, January meeting expectation of an increase there. And also that even if we remain flat, we're not actually easing. And I think to a certain extent for a while there, the market was sort of expecting that, just kind of a turnaround and that the rate is coming back down pretty quickly in the course of 2023. I think, again, I just don't see that happening in the near future. We do know that, historically wages, jobless claims, right? This kind of stuff can get hit more towards the end. So the fact that jobs unemployment is still low now is not so surprising, right? We would expect maybe 12, 18 months in to start to see the pain from the unemployment and, more of the recessionary conditions that we would associate outside the market happening. But that does mean that the Fed is empowered to continue kind of taking the stance it's been taking, at least as we move into the early part of 2023.
And digging into the labor market, you say that the bad news is actually good news for the stock market, but for the time being. At what point does it start becoming bad news for the markets?
Yeah, it's a great question. I mean, it's good news, obviously, in the sense nobody wants to see unemployment. But from the market's perspective, you have to see some weakening in the employment picture because we have to see wages, the stickiness of inflation in wages start to ease up because we know that's what the Fed is focused on. So the market is kind of waiting for a report that sort of says, OK, we're peaking there, too, in terms of wage increases. We're maybe getting on the other side of that. And that in turn would obviously potentially lead the Fed to say, OK, now it's time to start easing on increases, maybe even pivoting the other way. So that's the reason that's the sort of thinking that we have here. I will say, right, there's a lot of other indicators of weakness that we're starting to see and, probably will see as we head into 2023. Corporate profits probably need to come down a lot. You're still seeing, obviously, inverted yield curve. You're seeing issues in Russia and Ukraine. I mean, we're going to be going on a year, and I don't think anybody thought that this was going to last as long as it has. China's still working through the segment you just had, right? Great information around just, China working through its policies. So there's a lot of issues that kind of loom for the market in general, for the economy in general. The labor is just kind of this holdout, but the Fed's mandate is inflation and unemployment. So those are the two things they really focus on.
So then, as we mentioned, all those factors that you just laid out there, what does that mean in terms of asset allocation? What do you do for your portfolio when you have so much uncertainty?
Well, the standard advice, of course, is you have a good mix of equity and fixed income. I think everybody really got a startling surprise this year when the 60-40 kind of failed in that respect. We saw double-digit drawdowns both on the equity and the fixed income side. And of course, that's because you had these really sharp run-up in interest rates that killed, fixed income. Of course, for the most part, we're past that huge run up, right? So now we're looking more at priced in increases. maybe staying higher for longer than we'd like. But in terms of actual losses in fixed income, I think, the general consensus is we should start to think about moving back into fixed income, even though clients are maybe, have a little bit of trepidation around that. So number one on asset allocation is, the fundamental advice of being at the right equity to fixed income ratio in terms of what your risk tolerance can handle is still very much applicable here, in spite of what we felt in fixed income markets. And then I would say on the equities, you're looking probably at defensive stocks, at least for the time being, if you're trying to react to what's going to happen in the short term. So if you're trying to say, I want to feel safer in the holding and the asset allocation that I have, you're looking at quality stocks, you're looking at low volatility stocks. I would say, though, if you're in the market for the long haul, as hopefully most clients are, then, small caps, obviously being international, what markets are cyclical, right? So what's worked in the last 10 years, oftentimes the next 10 years is different. We've just had a period of time where US stocks have outperformed dramatically. So there should be an expectation that, things can swing over to the international markets just based too on valuations. But that might not be as a defensive, comfortable place for clients to be. So if they can stomach that and be, kind of have that longer term view, it's probably a good opportunity to diversify into those areas. So it really depends. Am I looking at this on a short term or a longer term basis?
So there you go. Check your time horizon and your risk tolerance. A big thank you to Dana Dioria, Investnet PMC Co-Chief Investment Officer. Thank you for joining me this morning.
As many economists have recently began forecasting that the U.S. will sink into a recession next year, 2023, our next guest made that call early on, in early 2022, saying that the economy had significant near-term momentum that would later on lead to market imbalances. That's Deutsche Bank's chief U.S. economist, Matthew Luzetti, who joins us now and still maintains that view. He joins us here in Living Color, live in Living Color. All right, so since you predicted the factors that would lead to or trigger a recession, what would you look towards in terms of the flashing signs in order to lead us out of a recession, or the light at the end of the tunnel, perhaps?
Sure. So I still think there's a lot of uncertainty about the timing of recession. We've maintained a call that it's the second half of next year. And I think we've seen a lot of evidence that I think supports that. In the near term, we just saw GDP getting revised up in Q3. We do still think that there's meaningful momentum. Q4 growth looks okay. I think in Q1, you still have decent momentum. But as you get towards the middle of next year, I think that's where the risks begin to build. I think a key part of that is the U.S. consumer and the drawdown in excess savings that is ongoing. And so I think you'll see a consumer that looks a lot more fragile in the middle of next year. In terms of what we're looking at, I think it's all about the labor market. When does the labor market really begin to show signs of slowing? I think continuing jobless claims are typically our best real-time indicator of recession. As we saw this morning, they remain very low. So you have a labor market with a lot of momentum in the near term. I think that'll keep the Fed raising rates. Ultimately, though, I think that does mean that we have tighter financial conditions as you head into next year and a slowdown in the economy in the second half of the year.
Do you still think there's any chance that we get a recession here where we don't see a spike in unemployment? Or is that, the Fed has said it doesn't think that's going to happen, that we're going to start to see unemployment move towards 4% and beyond.
Yeah, I think when you look at the Fed's forecast, it is as close to recession as you can kind of get.
Without calling it a recession?
Yes. There's three officials that actually have negative growth forecasted for next year. But at the same time, it would be the lowest unemployment rate rise that you've ever seen in a recession. Recessions, typically if the unemployment rate rises by 50 basis points, it just accelerates from there. And so I think a key question is, I guess, one, when does that begin to happen? We don't think it really begins to happen until the middle of next year. And two, how much is the rise in the unemployment rate that we anticipate? We expect that you'll see about a 2 percentage point rise in the unemployment rate, which does sound like a lot, I think. But from a historical perspective, it's actually a quite mild recession. And I think you have employers that have a lot of incentives to keep labor. We're still a very tight labor market. I think they found out with COVID that it was difficult to go back and then rehire if it was a temporary slowdown. And so I think some of those kind of labor hoarding incentives will probably keep a cap on how high the unemployment rate will rise.
And I was reading a good feature by our Jen Schomburger on the year that has been for the Fed. It's been quite the year. As someone who covers the Fed and what they do, what grade would you give them in terms of performance this year?
Look, I think if a year ago, if we would have said that they would have hike rates by over 400 basis points this year, I think it would have been absolutely shocking. I think the starting point from where they were offsides in terms of where the inflation was, as many of us were, in terms of how tight the labor market got, how high inflation began to rise. I think they did a really good job this year of right-sizing monetary policy. They caught up very quickly. They took bold steps to take 75 basis point rate increases at 4 consecutive meetings. I think that has left them in a good spot at this point. It doesn't mean I think that the base case is a soft landing, but I think that they have maximized their chances in order to get a soft landing.
For what you're seeing with consumer right now and debt levels, you mentioned a moment ago some of the savings are already beginning to be tapped, but where is debt starting to pile up on the consumer front? And even in the shift of spending right now, we're seeing more consumers lean on credit cards and things of that nature in order to get them through to the other side.
Yeah, credit card growth has been very strong recently, but I think there's important context, which is we're basically catching up to pre-COVID trends and levels that we would have seen. Typically, you want to normalize those debt burdens by income or disposable income. And the consumer really looks good on those metrics still. So the way that I read that data is it's early signs that a good portion of the income distribution is beginning to eat through their savings that they've had. It's meant that they are now needing to fuel consumption by borrowing. I think a key data point is what you've seen with the U.S. savings rate. Over the past 3 months, below 3%, basically record low levels. That's very clearly an indication that savings are being drawn down very quickly. And as we head into next year, I think debt is a more important driver of consumer spending trends.
Matt, as we go into next year and as you have this sort of base case forecast, are the risks more to the upside or the downside? Like the rhetoric feels more downside-y, but which way would you go if you had to guess, like where could surprises come from?
Yeah, I think if anything, the risk to our view is that the recession comes a little bit later, that we don't get it by Q3 or the middle of the year, that the labor market just has a bit better momentum, that good momentum feeds into consumer spending that remains more resilient, and that pushes out the timing of a recession. I don't think that necessarily tells us that we won't have a recession, perhaps by early 2024. I think what that'll mean is that the Fed will likely have to raise rates more, wage growth will be more persistent, price inflation will likely be more persistent, but that the whole manifestation of the recession just takes a little bit longer.
It's been fun following your work all year. Appreciate you always coming on. Happy holidays. Matthew Lozzetti, Deutsche Bank Securities Chief U.S. Economist. We'll talk to you soon.
Thanks so much for having me.
Here now your closing bell for Tuesday, 20th. Ladies' Day on Wall Street. We got some green numbers snapping a 4-day losing streak. The Dow up 92 points. The S&P just barely in the green, but we will take it and look at the NASDAQ by the slightest of margins again with the bleak outlook we've had. My friends, we will take it. For a closer look at the broader markets, let's bring in Barrett Asset Management Chief Investment Officer Amy Kong. Amy, nice to see you. Look, they're very slight gains, relatively low trading, but we'll take it. What do you make of it?
Hi, guys. Thanks for having me. I hear you. It's one of those days where we'll take it after 4 or 5 very tough sessions. And it's really just perhaps waiting for that next data point to come out, which could possibly be PCE numbers coming in on Friday. So perhaps that volatility might start to go up higher by the end of this week.
Amy, what are you expecting to see from that print? And then looking out just in terms of how we will likely trade over the next several weeks, what are you expecting there?
Sure. I think the PCE number could come in very similar to what we saw with the CPI numbers, meaning that there is this peak inflation trend forming. And that hopefully could support the argument that the Fed will likely slow down, not stop, but slow down into 2023 in terms of its interest rate hikes. Coming into 2023, this Santa Claus rally that we've all been waiting for, the chances of that is dimming a little bit. Although I'm not surprised, I wouldn't be surprised, let's call it, to see perhaps the last trading days pick up a little bit. We tend to see that. But then, of course, as we go into the new year, there could continue to be volatility as new calendar year. People could be taking some gains off the table again. And so, again, that volatility could pick up as we enter the new calendar year.
And so just to be clear and zero in on what you think the Fed will do, Amy, you think 225s and a pause?
Yeah, I think, right now, I don't think a pause is in the cards yet for the next couple of FOMC meetings. Right now, CPI has come down, but it's still very high on an absolute level. And so if that continues, meaning the trend continues to soften, we could see CPI and the Fed funds rate start to meet somewhere between that May to July period. And that could be somewhere between 3.5% and 4.5%. So I think the next couple of FOMC meetings, I think they'll continue to hike. I think 50 basis points may be in the cards for January. We'll have to see what the next couple of CPI numbers come out with.
I mean, there is some concern out there that the Fed has been too aggressive already, that it will continue to be too aggressive, and then the implications from that. Are you at all worried about that aspect of this equation yet?
I certainly am. I think you raise an excellent point. And one of the biggest risks on our laundry list of worries, if you would, is Fed policy error. The Fed uses data points that are somewhat lagging to make its financial decisions or monetary policy decisions. And while, they want to fight inflation, I think it does take time for past rate hikes to really trickle into the system. And the past couple of rate hikes have been very aggressive. So I do think they need to recognize that. So while at the same time it is tough because you have to balance the fact that if you were to pause or send the wrong message, you can send the markets into some kind of tailspin, and you want to avoid that as well. So I think maybe, that 25 to 50 basis points rate hike going into the next several meetings makes sense. But I think pausing without seeing the inflation data points, I believe that could be an error.
And if they do make that error, where would it be reflected? Where would we see it first?
You'll see it both in the stock market and the bond market. I mean, the bond market is sending a message to the Fed right now that they are probably too aggressive. And you can see that with Fed funds futures. Bond market traders are expecting rate hikes by the back half of 2023. And so there's definitely going to be some reflection there. The stock market will also be very responsive in the sense that, they're hinged on every word Jerome Powell says. And so any error or any, confusion, if you would, in terms of its language, I think the markets will definitely show it through volatility.
So, Amy, what does all this mean from an investor perspective, and what people should maybe be prioritizing or buying at this point?
Sure. I think from a stock market perspective, we don't think that it pays to be overly exposed to the stock market at this point. So we are not allocating any new dollars to stocks at this junction. Where we are putting that money is probably in the bond market, and we are starting to see yields pick up. And we're also starting to expect yields to peak sometime in Q1/Q2 of next year. So where we have been hiding in very, very short-term treasuries over the past 12 months, going into the next 12 months, we're actually looking to elongate duration in our portfolios, meaning we're looking to probably lock in some rates, perhaps up to 5 years in maturity, so that, again, if the recession does happen and the Fed has to actually reverse course, we're actually locking in some pretty decent yields going into the next couple of years.
And what's your prediction for equities moving forward in 23?
That's a tough call, right? So, all throughout 2022, we've had a PE contraction, macro conditions causing that, the Fed causing that. And going into 2023, if the P part of the price to earnings ratio is not to move higher because of macro conditions, it's really reliant on the E portion of the PE. And earnings could be at risk going into next year, considering that many of the companies we follow have not yet provided guidance. So that actually would be an important hurdle for us to get through, that we'll obviously see more data in January into February in the next earnings season. And we do expect those numbers to come down. So our outlook going into 23 is somewhat cautious, considering that the earnings portion is likely at risk.
Amy, when it comes to the consumer has in fact been relatively resilient when you compare just in terms of the deteriorating economy, the higher costs, everything that the consumer has been facing up until this point. What is your outlook there just in terms of how much the strength of the consumer might be able to offset some of the weakness that we're seeing more broadly speaking in the economy next year?
Excellent question. I think you're right. The consumer has held up very well. A lot of that is based on two main factors. One is just excess savings from the pandemic, right? The government was basically shoving dollars into our pockets in some form or fashion. And that's is somewhat waning a little bit, especially with some of the lower income earners. I think the other aspect that's been holding up well is wage inflation. It's still hovering around that 5% level and has been able to offset some inflation that we're seeing in the food and energy, at least for the first part of this year. And so overall, the consumer has been holding up well, but we are starting to see cracks. Retail sales numbers are softening. That is a reflection of consumers turning more and more cautious as we head into 2023. And in general, the savings rate as a percentage of disposable income has also come down quite a bit. So what that means is the inflation part from wages has helped, but then people are saving less to, again, make up the other half. And so what we're seeing is savings rate is now down to 2 to 3%, which is somewhat low compared to what we've seen in the earlier parts of the year or even pre-pandemic, which had been somewhere in the high single digits. So I think the consumer is still holding up, but we're starting to see some cracks in the system.
All right, something to worry about here as we enter the new year. Amy Kong, always great to have you. Thanks so much for joining us here this afternoon.
As more data comes in showing a struggling housing sector, the National Association of Home Builders CEO, Jerry Howard joined the show earlier today to tell us what they see happening. Listen.
So cost of construction, the cost of capital, it's all playing into it. And that's having an impact where we firmly believe that we're in a housing recession right now.
Joining us now to weigh in on this is Lawrence Yun, National Association of Realtors Chief Economist and Senior Vice President of Research. Lawrence, nice to see you as always. Are we in a housing recession? And how do we define it? We got caught in that trap with the overall definition of a recession recently as well.
Well, good afternoon. I would definitely say we are in a housing recession because it's contributing negatively to the GDP growth. It's cutting into it. Housing starts are down. Home sales are down. There's some layoff in the industry. But the most interesting aspect from consumers' point of view, homeowners, they're doing fine. I mean, they have seen substantial growth in their wealth from rising home prices, very little foreclosure rate, mortgage default rate at historic low. So we have a divergence. People in the industry suffering due to the lack of activity, yet homeowners are doing very well.
So, Lawrence, we have housing starts off 16% from a year ago. Permits are down 22% from 2021 in November. Just in terms of what this is signaling of how much worse the industry could potentially get over the next 12 months. What do you think?
Because of the lack of buyers, the builders are becoming very cautious. Now, we have to remember, we had a housing shortage before COVID. Inventory levels were low. Then the first couple of years during the COVID, when the home sales boom, we had an exacerbated housing shortage with multiple offers widely prevalent. But now with the buyers retreating because of much higher mortgage rates are the drivers. High mortgage rates, buyers retreating, we still have some degree of housing shortage, but definitely it's taking much longer to find that right buyer in order to make that sale.
Mortgage rates up on the screen, and they are down considerably, frankly, from north of 7. That's maybe the only good news right now. Where do you think they settle in at middle of next year?
I would say 5.5% is probably the case because, we have the Federal Reserve who will continue to raise interest rate probably 2 more rounds. But the mortgage rates have already priced that in that information. And with the inflation expected to retreat, from the 9%, 8%, 7%, and possibly 4% inflation by end of next year, that means that the Fed may be able to cut interest rate towards the year end, which means that mortgage rate may be pricing those future possibility into the current mortgage rate. So it could settle down at around 5.5%.
Lawrence, in terms of this weakness that we are seeing in the housing market, I guess how long do you expect that to persist before we start to see any improvement?
I think it's 1 or 2 additional months of low sales activity because, as you mentioned, mortgage rates have fallen for 5 straight weeks. And mortgage rate is always the key leading indicator. And all that will lead to buyers steadily coming back to the market. And if the mortgage rate decline further, as I expect towards next year, then there will be greater number of people entering the market. The key question is whether there will be sufficient supply. Because again, we had the housing shortage, and then housing shortage does not appear to be at the present, but when the buyers come back, we could again face that issue.
All right, we're looking forward to next year, and you're showing us the top markets for real estate next year: Atlanta, Raleigh, Dallas, Fayetteville, Greenville, South Carolina, all pretty much concentrated, relatively speaking, in one portion of the country. What is it that connects these two? What's the common thread among these top markets you see for next year?
Two factors. Affordability. They are relatively affordable, definitely compared to, say, California market or New York. And the second factor is much faster job creation compared to the rest of the country. So a combination of affordability and strong job creation will lead these markets to outperform.
Are these markets that investors are eyeing right now?
There is a more than usual investor activity compared to other markets. Now, the investors are not interested in million-dollar home. They're interested in those starter homes, which they get converted into rentals. So the investors are present, but I think the first-time buyers, they're eager to get into the market. And given that the prices are relatively affordable, if the mortgage rate goes down, continuing job creation in the local area, boom, you have the buyers coming in.
Lawrence, you just mentioned rentals there and what investors might potentially be doing with some of these homes that they are scooping up. When it comes to rent prices, we certainly have already seen a large jump this year. What are you anticipating that we'll see next year?
We have the record high, or I should say 40-year high in apartment buildings right now. So single-family home construction is down. So the home builders are suffering. But the apartment building is at a 40-year high. All this excess supply coming into the rentals market will calm down the rent growth. Rents have been rising faster than 10% in some of the private sector data. Now, CPI has not yet incorporated those information, but now we have turned a corner. Rents are rising, but at a slower rate than before, and this will contribute to actually falling overall CPI, but also the fact that the renters will get some relief next year.
A lot of talk about the bond market. What do we see happening after a brutal year in 22?
I agree. We're ready to put this year behind us. And so let's take a look at where we are in the bond market. This is basically the entire history of the U.S. And U.S. bonds right now on track for their top 10 worst return since the birth of the Republic. And here we are all the way over in 2022. Here's that negative red candle. That's basically down 15%. You don't see that often going back 200 plus years. Now, you do see that in this area in here in 1916 to basically 1980, I guess it's not circling right now, in here you do have a lot more down years, but my point of putting this up is that you can have several, up to 5 down years in the bond market cluster together. Now, when we talk about the 60-40 portfolio, that adds some diversification. And so if we were to look at what's happened with a 60-40 portfolio since 1950, here's this nasty downdraft that we have right here. That's down 22%. Here's March of 2009, down a little bit less. Now, what we had going for us in March 2009 was the Federal Reserve was amping up. It was getting ready for Bazooka QE1, and stocks took off to the upside. Bonds didn't do much, but we had this balanced portfolio. So the question is, what happens with correlation? Now, this comes from Bespoke, and this shows the rolling 3-month correlation between stocks and bonds over the last 5 years. In the early days of the pandemic, we shot up, and now we're up here again. That means if bonds are going up, that means if yields are going down, that means equity should be going up, and vice versa. And what the problem is, we've been having these scary surprises up in bond yields. So that means bonds are going down and equities are going down at the same time. Now, here is the critical chart, and this comes from Jim Bianco. This is where the rubber meets the road. This is what the Fed is forecasting it's going to do in the blue line versus the market. What the market thinks is going to happen in the orange and green line. So the Fed in 2023, this goes through each month of the year. They think they're going to raise rates in the early part of the year up to about 5.25%, and then they're going to hold there from May until the end of the year. The market's saying no. These lines here are what the market expects both before and after the Fed announcement last week. They're saying that there's going to be a come to Jesus meeting sometime, and we're going to see what the difference holds. At that point, in theory, we should get a nice downdraft in yields And because stocks and bonds are still highly correlated, perhaps at that point we get that updraft in stocks, and then we get that liftoff that everybody's been expecting. But the problem that has happened so far this year, everybody's been front running this trade, has not happened yet. So if it happens in the first part of the year, maybe that's something to look forward to, but not in the present circumstance, guys.
Well, U.S. housing starts, they were down 0.5% in November to its lowest level since August of 2020, while building permits tumbled roughly 11% to their lowest level since June of 2020. The National Association of Home Builders CEO Jerry Howard is here to discuss. Jerry, great to have some of your time this morning. What we've also seen, even in the earnings of some of the companies that have reported, for where we are still seeing some weakness, it's not just in the number of homes that are starting to be contracted, but it's also in the prices that people are willing to pay for homes. Where do you expect there to be some strength that the industry can eventually see, especially as the Fed is continuing on its own pathway in this rate policy?
Well, first of all, the area of strength is one that is always strong, and that's the very high end of the market. Those who are buying second homes and the very wealthy, they have money now, they can afford it, and they're still buying. So the builders that focus in that segment of the industry are doing relatively well. The rest of the market is not looking very strong for 23. I'm particularly concerned with the first-time home buyer quadrant, and I'm concerned with that because that really dictates the health of the entire chain of housing. And so it's very, very difficult to build at that price point right now, and it's something that we're watching very carefully.
And so, Jerry, it's Julie here. What changes it? Is it just a matter of when the Fed stops raising rates that things will be allowed to improve?
Well, the Fed and their interest rates has an impact up and down the chain, obviously. In the first-time home buyer market, it's also the fact that cost of construction is still like 10% higher than the inflation rate is. So cost of construction, the cost of capital, it's all playing into it, and that's having an impact where we firmly believe that we're in a housing recession right now.
Jerry, some commentary recently from RH CEO, of course, of the high-end home furnishings company. That CEO says the housing market is collapsing. Do you share that view?
I think we're in a housing recession right now. I do think that this is going to be different from 08. I don't think people should panic here. And the big difference is in 08, we had a glut of supply. Here we do not have a glut of supply. In fact, we have a supply shortage, and that's going to limit how low prices can drop. So I think we're going to be in for a rough year in 23. But I think the floor is a lot higher than it was in 08, and will come back a lot faster. We're looking for a turnaround in early 24.
What will lead that turnaround?
I think what will lead that turnaround is going to be a reduction in interest rates, and I think we'll ultimately get our supply chain back in order, which will help bring down construction costs. And I also think that policymakers are starting to realize that a lot of the policies we have at the local, state, and federal level are adding to the cost of housing, and I think they're finally going to do something about it.
National Association of Home Builders CEO Jerry Howard, good to see you. Happy holidays.
As we continue to wind down 2022 and look ahead to the new year, our focus, much like the Fed's, remains on inflation. And according to our next guest, as inflation improves, more financial conditions loosen, making the Fed's job even harder here. So joining us now to break down all of this and much more is Jason Katz, UBS Managing Director and Private Wealth Advisor. Jason, good to have you here with us on this holiday week. Given what we've seen in the markets leading into these final weeks of the year, all the focus now is clearly on 2023 and just what the Fed's pathway may be. What are your biggest expectations and the tenor that the Fed is going to strike going forward once we get into the new year?
Yeah, look, if you annualize inflation over the last 3 months, we're actually looking at headline inflation at around 3.5%. But that's not the 2% inflation target. So we have this catch-22. The reason manufacturing inflation is down is the reason service inflation's up. We're not at home buying stuff, we're getting out and doing things. And the real catch-22 is the more that headline inflation improves, the more financial conditions loosen. And the more that those conditions ease, it makes the Fed's job all the more harder. So there was no surprise of what was said or done for that matter at the Fed meeting. And the market's reaction suggests that investors are getting the memo. The Fed is saying what it means and meaning what it says, and they're unapologetically hawkish. And I don't think they're going to relent on tighter policy until inflation's under control. What they may relent on is what that target ends up being. It may be a 3.5% target, not necessarily 2%. We shall see.
Jason, maybe I'm getting inspired by that really cool bull on your wall there, which I'm going to take this offline. I need to know where you got that thing. But what stocks should people be bullish on after a very challenging year this year?
Yeah, I mean, listen, you want to find industries that are thematic in nature. And I think there's some investable areas, regardless of whether we have this recession, how deep and how long it lasts. You take, what's happened with the war in Ukraine and the lessons learned there. Companies aren't as focused right now on price and efficiency. What are they focused on? Safety. So you think about energy, think about cybersecurity, or you think about food and agriculture. Food, for that matter, getting clean water to polluted areas, or companies that boost the agricultural yield by making vertical farms. So you're looking at areas that, regardless of whether the war persists or inflation rages, are going to continue to thrive. Cybersecurity is another incredibly investable area. We can't be beholden to our enemies for our energy, our food, and now we need to protect our companies, our governments, and our schools. And cyber spending is a prerequisite for every business leader I speak to.
Jason, I'm going to take the flip side of this. What do you think? What are you avoiding at all costs going into 2023?
Well, I'm avoiding some of the really crowded trades. For instance, a lot of the defensive areas like consumer staples, or utilities for that matter. Utilities are very bond-like, and listen, I manage money for individual high net worth investors, and everyone was in the pursuit for safety and yield, especially recently. And the valuation in an industry like utilities that doesn't really grow earnings and are regulated are hypersensitive to moves in rates. And should the 10-year get back over 4.5%, there's meaningful downside there.
What type of shift would you need to see in not just the Fed's policy, but perhaps in the broader environment for technology, which has been a sector that has led us through bull rallies and bull markets in the past, for that to be a kind of reconcilable decision for somebody to make within their portfolio?
Look, investors are a creature of habit. And having done this for 3 decades, I see people have the muscle memory of buying what they're familiar with and what has worked. I'm not saying to abandon tech, or big tech for that matter, but 60% of their earnings come from overseas. Any strength in the dollar, or any weakness overseas, or weakness in consumer ad spending just don't bode well for that industry. So for that to get investable, growth can't come down as much as feared. And if it doesn't, then I think you could definitely see a resurge in technology, but there are far better, more investable areas at this point. Fixed income, being one of them.
Point well taken. Jason Katz, UBS Managing Director and Private Wealth Advisor. Good to see you. Happy holidays.
You too.
For more, though, on the markets, we're joined by Allspring Global Investments Senior Investment Strategist, Brian Jacobson. Brian, always good to see you, sir. I want to get back to some of that housing news we just read. We're talking about an NAHB 12 straight months of down readings and the lowest number in a decade other than that blip in early COVID. Indicative to you of what?
Yeah, I think that it actually is just reflecting the reality of a recession that the United States is likely to go into in 2023. When I look at a variety of different macro factors, I think that there will probably be an official recession probably around Q2, so end of second quarter of 2023. Arguably, we already had one at the beginning of 2022, so this might be a type of double dip. And it's been bad for housing. Housing has been down for, I think it's been more than 8 fiscal quarters in a row as far as on an inflation adjusted basis. Initially, it was due to lack of workers, right? So there was just too much work for them to do, but they couldn't find anybody to do the work. And now we've got higher interest rates and going into a period of time in which not only do you have some of these supply side constraints, but also probably some demand destruction that's likely to take place. So kind of a triple whammy there for housing.
Yeah, certainly housing has been under pressure. Really, the broader market has been under pressure over the last several trading days. The S&P now lower for the fourth day in a row. Brian, is there any chance that maybe we could get a rally into the end of the year? Any good news maybe on the horizon for us?
Yeah, so I'm actually somewhat constructive on the idea that we could get an end-of-year rally with some weakness going into Friday's personal consumption and expenditures data, which is, granted looking backwards. So it's like what were people spending their money on back in November? What was income? I think that we'll see some weakness there. But then also within that report, you get the inflation indicator that the Fed officially is targeting, the PCE price deflator. And that's likely to show some moderation. So if you've got some weak consumer spending, weak income growth, weaker inflation, that might sound like a horrible mixture there, but it actually could be a good thing in the sense that it suggests that the Fed might not need to hike quite as much as what people have originally been fearing for 2023. So that could maybe trigger that Santa Claus rally. And remember, the Santa Claus rally, historically, it starts after Christmas, not beforehand. So I think that we could be setting ourselves up for at least maybe a little bit of a bounce back to end the year.
Hey, Brian Prosser, just want to follow up on that commentary about the Fed and rates. Do you think that the doves might see some kind of action here because of the fact that we might see some weaker data coming out of January?
I do. And actually, I think that when I looked at the summary of economic projections that the Federal Reserve released, it was really interesting to see the consensus view for where the Fed funds rate should be at the end of 2023. There were 10 participants that thought that it should be around 5.1% or so. So, right, that's a few more hikes away. There were only a handful that really thought that they needed to go materially higher than that. So those are the most hawkish members. They're also the ones that tend to squawk the loudest. The doves have been a little bit quiet, but I actually think Lael Brainard, as the vice chair of the Fed, I think she's in that little bit more dovish camp. I prefer to think about it as the more prudent camp, to think that we've done a lot already. Let's maybe take a pause and see how things play out. And I suspect that she's actually carrying the majority of the members behind her view here. And it's just a few outliers that are a bit fringe with their views.
Quite a burden to carry there. All right, so the implications, given that setup, the implications and the layout for the bond market.
Well, on my team here at Allspring, on our multi-asset team, we actually have a positive view on the outlook for bonds for 2023. It requires a little bit of pain that we experienced in 2022, but just historically, when we've looked at periods of a recession, what oftentimes happens, you actually get bonds doing pretty well. What happens when the Fed gets closer to their peak for tightness, which I think we're pretty close to there. The end isn't necessarily here, but the end is near for rate hikes. And that actually tends to be a very bullish indicator for the bond market. So here, we're actually pretty optimistic about the outlook for the fixed income markets overall.
And Brian, when it comes to, I guess, what investors should be watching, the biggest stories right now outside of the Fed, of course, there's also earnings. We have FedEx and Nike after the bell tomorrow. But looking further out into 2023, we certainly have already seen some of those estimates come down just a bit. What are you expecting? And I guess in terms of the leadership, what are you expecting to kind of lead the next leg higher potentially?
Sure. So I think that we could actually see smaller cap stocks lead the way higher. And not to say that you shouldn't be investing across the capitalization spectrum. Diversification is wonderful. It's in the textbooks for a reason. But as far as tilts in that, I think that actually some of the smaller cap companies could experience a decent rebound, but even more so emerging markets. So when I look at the earnings picture, and I think earnings will be the story for the first part of 2023, expectations for the S&P 500 on the sell side, those are only down maybe 6% from their peak. And so that's not a huge move lower. That's about what we saw in 2015, 2016, where you've seen a massive repricing and almost kind of a wipeout of some of the expectations is in emerging markets. There's basically people are expecting no growth in emerging markets, and those expectations are down about 24%. From where they were at the beginning of 2022. So emerging markets, I think, are the ones where you've already seen sort of people just throw in the towel on them. And when people throw in the towel on them, that's where I want to kind of start picking them up.
Brian Jacobson, thanks so much, man.
All right, let's get you up to speed now on the Fed. A few Fed bank presidents are speaking today, and Jen Schomburger has the details for us. Jen, what are we hearing?
Hey there, Dave. Good afternoon. San Francisco Fed President Mary Daly says she's not convinced on signs inflation may be cooling yet and says we've got a ways to go. Speaking virtually at the American Enterprise Institute this afternoon, Daly says the key to bringing down inflation is rebalancing the labor market in order to bring wage growth down. Take a listen.
The labor market remains quite out of balance. We have too many jobs and too few workers. So that means that wage inflation is going to be above its long run sustainable average, and we're going to have that passing through to prices. And that's what we're working on right now. That's why my projection has gone up.
Daly, like other Fed officials, says she thinks the unemployment rate will need to rise to about 4.5% or slightly higher to restore balance in the job market. She says wage growth is still running around 4.5% to 5% and needs to come back down to 3.5% to 4%. Daly says that means higher rates held longer. When asked whether holding rates at high levels for some time, as Fed Chair Powell has said, means 11 months, as has been the case historically, Daly called that reasonable, but said that the data will determine that. Now, elsewhere, New York Fed President John Williams told Bloomberg Friday it remains possible the Fed raises interest rates more than it currently expects next year, adding that he's not expecting the economy to fall into recession. Now, officials have penciled in estimates for rates to peak around 5.1% next year. Of course, they have repeatedly revised higher their estimates for rates every single SEP we've gotten this year, and Powell did not rule that happening again at the March meeting next year.
Welcome back, everyone. As inflation continues to ease, our next guest says consumers should expect this to lead to more opportunities in the market, with data predicting rent increases of 4 to 6%. Walker & Dunlop CEO Willie Walker joins us now. Willie, great to have you here with us this morning. All right, so what opportunities specifically should some consumers expect?
Well, I think we started to see some optimism about what might happen with rates prior to the announcement yesterday with the inflation report day before yesterday. I will say that Chairman Powell did a good job of trying to take away any optimism that came in with that inflation print during his press conference yesterday, and the markets are reacting to that. We had thought that maybe there was 50 basis points this time, and then we'd get maybe a 25-25. Chairman Powell yesterday talking about another 50 basis point increase, I think has put a lot of downward pressure both in the tech sector as well as in the real estate sector. But there are lots of people like Jeremy Siegel at Wharton who say that the Fed's not going to have a choice, that the numbers are going to move materially, and that will give us some rate stabilization into 2023. In our world, unlike the single family world, where rates need to come back down for single family mortgage originations to pick back up, in our world, we really need rate stabilization. Owners of commercial real estate have been watching the Fed rate increases and rates go up precipitously over the past 6 months. And what we need is for some type of visibility into where the Fed is going so that people can make a decision about what type of financing to put on their property. And then you'll see cap rates adjust and you'll see transaction volume begin again.
So are you, I mean, maybe not a freeze, but what has deal activity kind of ground to a halt right now as people await that kind of visibility?
So you're sort of in between. Anyone who has discretion right now is either going with floating rate debt because they think rates are going to come back down in the kind of medium term, or they are on the sidelines waiting. What has not happened is you don't have a distressed market right now. So what you're not seeing is fire sales to try and raise capital. Been a lot of focus on Blackstone's B-REIT and about the B-REIT and what the B-REIT has been doing as it relates to redemptions. They put up the gates as it relates to redemptions on the B-REIT as well as Starwood's S-REIT. But both of them have those protections in place so that there isn't sort of a run on the bank. And I would think because of their performance that many long-term investors stay in those vehicles. But yes, transaction volumes are down precipitously over clearly a year ago. Q4 a year ago, you remember the 10-year a year ago today, I think was at 144, 145. So we've got 200 basis points added to the 10-year right now from where we were a year ago. And in an industry like commercial real estate that is so debt driven, that is invariably going to slow down transaction volumes.
Willie, are you planning your business next year on the assumption that the Fed cuts rates at some point?
Not cuts. All we need is stabilization. So if the chairman had come out yesterday and said, we see inflation abating, we got 50 now and we'll take a look at where we are, I think you would see a lot of investors step back in from a commercial real estate standpoint saying, I can start to see how much my cost of financing is going to be. Cap rates will adjust and I can start to transact again. I would say that yesterday's press conference probably kept a bunch of investors on the sideline. But as I said previously, there's no assumption in our business plan that they have to cut in 2023 for us to see volumes pick back up.
Willie, finally, I want to ask you about rents and what you see happening for rents. Obviously, that's one of the major areas of CPI that we've been focusing on, that the Fed has been focusing on. Do you expect to see any kind of stabilization there or even declining rent rates?
So we've seen rent growth fall off significantly, but we still have plenty of rent growth. I had Ivy Zelman of Zelman, which is a fantastic research firm, which just in full disclosure, Walker & Dunlop owns, on my weekly webcast last week. And I was actually very surprised that Ivy and her team still have a projected nationwide rent growth number of north of 5% for multifamily in 2023. I would have thought that number would have collapsed down to 2 to 3% rent growth on a national basis. Clearly, there are pockets where rent growth is going to be higher than that and others that are going to be lower. Many of the Sun Belt states that had massive growth over the past couple of years are going to see an easing of rent growth. And a number of markets where there hasn't been a whole lot of supply coming in, such as California, are going to actually see healthy rent growth.
What we've also seen is platforms like Airbnb trying to get more into the rental space. And I think one of the recent announcements really signaled that in the long-term stays that they are seeing, that there is some opportunity for them to kind of play more of an intermediary role in the market. What does that signal to you and your company when you do see a major platform play like that on the technology front, trying to get more into the rental space and the rental market?
You know, I'm asked constantly about competition. Walker & Dunlop, which is a firm of only 1,500 people, goes head to head with JP Morgan, Wells Fargo, and CBRE every day. And for a long period of time, everyone says, how are you going to compete? And we've been able to compete. So the technology companies, while I do not dismiss them whatsoever, have had a very difficult time penetrating the commercial real estate space. Single family, they've done quite well, whether it be Zillow or some of the other platforms that have come into the single family space. But when you're talking in the commercial space where there's a huge amount of institutional capital and the decisions to either buy or sell a property or to finance a property are tens of millions of dollars, we find that the diligence that is needed and the human interface that is needed to make those transactions actually happen has not been disintermediated by technology. And so while there's always we're investing in technology a lot, as are those three big banks and services firms that I've just talked about. But for new entrants, Airbnb is an incredible platform. But I do believe that people go to Airbnb to figure out whether they're going to go on vacation and not necessarily where they're going to rent their next property.
Willie, good to catch up with you. Willie Walker, Walker & Dunlop CEO. Thank you.
Thank you.
All right, there you have it. Fed Chair Jerome Powell wrapping up his last press conference of the year before the next meeting, of course, next year, post-Christmas. No real surprises there whatsoever from a remarkably consistent Jerome Powell for the last several months, kind of reiterating where the trouble is, where the stickiness is. Check on the markets here. They reacted positively momentarily, not entirely clear to what. But look, nothing really stands out here other than, Shauna, remarkable consistency, price stability, a commitment to 2%. And staying in restrictive territory, sticking to that 5.1 number, nothing should have surprised the markets today, at least from my estimation. You?
No, exactly. We know the Fed remaining very hawkish, the tone pretty consistent with what we heard from the state, or what we got from the statement when it comes to the Fed, comparing that to what we just heard from Fed Chair Jay Powell, saying that we still have a ways to go. The language keeping pretty consistent. Powell saying that we're not at restrictive enough a policy stance yet. Can't say confidently that we won't move up peak rate estimates here. Labor market remaining extremely tight, something that he touched on a number of times during that press conference. For more on the press conference, we want to bring in Brian Belsky, BMO Capital Markets Chief Investment Strategist, here on set with us today for Fed Day. So
this is exciting.
This is very exciting.
Live in
the
New York.
excitement's all over here, all on our side, sir, and spectacularly dressed, may I say.
Very, very well dressed. You dressed the part today.
Thank you so much.
Well, let's start with what we just heard from Powell. 50 basis point hike, 5.1% rate by the end of next year, much higher than what we had initially maybe anticipated. Stocks initially dropping on that news. What do you make of it?
I'm going to go OG on you, kind of going back to the sports, use the sports analogy. You'll like this.
I will. I'm listening.
So it's a Alabama football game. They're playing my alma mater, St. Cloud State.
Ooh, this could be ugly.
Yeah.
Tough matchup. Not a good start.
40-point spread here.
It's 81-3 with about 5 minutes left, and Saban's going for 2. So what's the analogy? We know what the outcome is, right? The Fed's going to win, and Alabama's going to win the game, and they're just pouring it on here a little bit. And the Fed, to me, and to the market, especially when the announcement came out, and he calmed some people down, calmed down a little bit during his comments, but they're going to follow the traditional Fed script and go too far. Everybody, we know this. So
over tighten.
And the Fed, the market and the economy especially, is being stubborn. And we've said for several years on your program that, that we're really good at a lot of things in the United States, but one thing that we're really good at is spending money. And I think some perspective needs to be added to this. If you go back a year ago, and I remember I was in December the first couple of weeks, I was in New York, the first couple of weeks in December, and then we had lockdown again from Omicron. We'd never really had a chance to live and be out there and do what we do in December, which if you've been in the city the last couple of weeks, it's been nuts. And so I think this is going to continue. And be that as it may, there are people worried about inflation, but we are seeing the signs of inflation rolling over. Now, the Fed does not meet until February. What if January and February we finally get month-over-month declines in CPI? I think that's why the market did what it did yesterday, didn't hold on to its gains. And whether or not you want to buy the rumor, sell the news, whatever happened yesterday happened. But clearly the escalator down in inflation is beginning. What we really need to see is the elevator down, and I think the elevator starts going down when we see month-over-month declines in CPI. So the Fed is saying, you know what, we're going to defeat this thing, but let's really defeat it, and doing what it usually does is go too far.
He's been clear they would rather over-tighten than come up short. But the difference with the football analogy, which I love, by the way, we know when that game's going to end. We know when Alabama's going to crush your alma mater. It's not entirely clear when Jerome Powell's going to win this and get inflation anywhere near 2%.
It's a wonderful way to put it. And, frankly, and we've said this the last 6 months or so, we've been wrong. We thought that inflation would roll over a lot faster. And it has been stubborn. And I think the Fed has recognized that as well, that it has been stubborn and continues to be stubborn with respect to inflation. But the tide is beginning to turn. We are starting to roll over, and the rest of the world is slowing down too in terms of its economy. That's why even with this, stocks lead earnings, which lead the economy. Market was down 25%. The next shoe to drop is potentially earnings, but not to the tune of 20% like most people are saying. It's going to be less than that. And I think that, along with comments and things like happened today, we're still involved with a momentum and reactionary market, and that's why you're seeing these reactions here. But I really believe, and our work shows it in terms of the fundamentals of the United States stock market, we really believe that U.S. equities are the most stable equity asset in the world, and we do think flows are coming back to the United States. And what's really interesting to me doing this now for my 33rd year. And I started when I was 9, Doogie Howser of Wall Street. People don't know that reference anymore. But I've never seen cash flow prowess. I've never seen balance sheet strength, and I've never seen earnings stability like I have right now across the market cap spectrum, from small, mid, and large. That's why we like small, mid going into 2023. Be that as it may, I do think we're going to see some volatility because it's not going away, especially in the next couple of months. I mean, we don't have a Fed meeting till February. Let's think about what we could see by then. We're going to see fourth quarter and year-end 2022 numbers from earnings in early January into February. Then we're going to start hearing more about real definitive forecasts for 2023, which are going to be squishy. Remember, we have reared now an entire generation of CEOs that underpromise and overdeliver and kind of are more conservative first. And I think they're going to be probably a little bit more conservative into their 2023 earnings. And that could make the market a little bit squishy the first couple of months of the year. I don't think it's going to be the full first half of the year. I think you probably have a better buying opportunity. I don't like to time the market very early on in the year. And I do think that we are higher by year end next year.
How much higher by year end? And more specifically, when you're trying to identify certain opportunities, are you looking for those beaten down names from this year? More specifically, maybe some of those tech or communication services names that have really lagged the broader market?
We are overweight communication services. We think it is the quintessential barbell sector and kind of pair trade sector. You know, we added Netflix to our value portfolio when I got beat up in May, June. So we like Netflix and Google, and then on the other side of the kind of the barbell, AT&T and Verizon, and Disney actually now recently has become more of a value type name. But we're not buying the long duration, high multiple assets with respect to tech. In our technology holdings, we're kind of matching up. So let's just talk about semiconductors, for instance. NVIDIA, we match up with Qualcomm in the portfolio. And so we don't want to have just the high multiple stuff. We want to match it up with a lower multiple kind of value-ish type tech. But to answer your question, I think we're entering into a prolonged period of more normalized trading. Everyone's been talking about normal. We've talked about normal now for 6 months. I think the path to normalization is a lot of things. It's high single digit to low double digit performance in the market. It's single digit earnings growth. It's 3 to 4% 10-year treasuries and 2 to 3% GDP. That's a pretty good environment for stocks. I think that's what we're going for the next 3 to 5 years in Canada and the United States, by the way. And so that stability, I think, will really draw investors back here. And then we'll see reglobalization and things like that. But onshoring and reshoring is a major theme. We wrote about it last week, and that's why we want to focus more on domestic names, and so therefore small, mid, and more value-ish over the next couple of years.
Because of that setup, you're underweight where and why?
Utilities and consumer staples. So, you know, people always say, Belsky, I have an opinion about everything. Well, one of the opinions that we have that is actually quite contrarian is we do not believe that utilities and staples are defensive. Now, on page 72 of your Rutgers
manual
on investing, it says be defensive and buy staples and utilities. But what our work shows is that the relative multiple, not just earnings, cash flow, not just earnings, but cash flow and sales, the relative multiple on consumer staples went up in 2022 the most it's ever had in history. And from a stability standpoint, their earnings are no longer stable. In fact, technology companies in totality are more stable in earnings than staples. No longer defensive, okay? So your Campbell Soup, your General Mills, you know, the end of the world's coming, you have to have your, you know, Cinnamon Toast Crunch. But on the utility side of things, utilities, people complain about long duration assets being technology, but if you take a look at just multiples, right? The multiples in utilities are very expensive. And so I don't see those as defensive names. Now, what's going to end up happening is we'll have some softness in the market. You're probably going to see one more spike in utilities and staples. That's going to be a beautiful exit point. So those are the names that we think you should be avoiding.
Well, Brian, then given that investment thesis, where do financials fall? Are you still seeing opportunity there? And more specifically, I guess, what do you like when you compare some of those larger banks to some of those more regional plays? We love the larger banks because of the multi-divisional asset parts of their businesses, meaning some quarters wealth management work, some quarters capital markets work, some quarters the commercial bank work. And I think the regional banks are going to be a little bit tougher, especially given the balance sheet opportunity of a Bank of America or even the Canadian banks coming down with the big balance sheets to do commercial banking loans. We also like small mid-cap financials like Raymond James and LPL because the brokerage businesses have been very strong. And remember, too, that brokerages do very well in a rising rate environment because, believe it or not, investors still trade on margin in the United States especially. And so the spread with respect to that they can charge on the interest rate side
it goes up, and those companies' earnings have been very strong. So we love financials. We think financials are the quintessential value sector heading into 2023. Healthcare looks very good as well. However, we've started to see some healthcare deals, and that worries me a little bit. And also, I think everybody's there, and they're kind of using that as kind of their growthier momentum area. And biotechs obviously have done terrible in the beginning of the year, but now they're doing a lot better. So from a multiple perspective, again, looking at cash flow, earnings, and sales, they're still below historical norms, but we've seen a big spike in how they've been valued. So we're overweight. We're just a little bit more selective. We like kind of life science companies, some drug companies, and some device companies.
St. Cloud State's finest, BMO
Thank
Capital
you.
Markets.
It's an honor.
Brian Belsky. Let me just drop an early Merry Christmas on you.
Merry
That's the
Christmas
first time
to you.
I've said that, but we'll see you next year.
Thank you so much. We appreciate it.
Great to have you here.
You got to
sir.
join
Thanks.
us back in studio again.
Yes, mid-January.
There we go.
January, he's booked.
Have you on the tee saying that.
Leave that jacket around for me. I appreciate that.
Thank you.
All right, now we're joined by Dartmouth College economics professor and former Federal Reserve Board special advisor Andrew Levin. Nice to see you again, sir. First, your reaction to the decision by the Fed and the language.
Yeah, I think that what's great about the Fed's communication is they have the statement, which almost zero changes today. There's literally like two words that are minor. Of course, the actual change in the funds rate. But what's important is the new projections that they've released and some pretty notable changes since September. What I would emphasize here, and somewhat distinct from the previous guest that you were speaking with, is I see the risk in a different direction going forward. The latest Atlanta Fed assessment is that GDP for this quarter is going to grow at around 3%, which is well above the kind of normal sustainable rate. Unemployment rate's still low. Jobless claims will get a new batch tomorrow, but they're still running very much like normal. The financial conditions have eased a lot. What I think could happen over the next 6 months to a year is the economy continues to be pretty robust and resilient. Business fixed investment continues to expand. Retail spending holds up pretty well. And in that world, workers still want cost of living increases, nominal wage growth can continue high. And that's going to lead to continued pressure on prices in the service sector. So what the Fed's alert to, I think you can see it now in their dot plot, is they got a ways to go. There's a benign case where inflation comes down a lot next year, not just in goods, but in the service sector and in nominal wage growth. But I think the scenario investors should be alert to is the possibility that even going above 5% isn't enough, that the economy is going to more or less continue humming along next year, and that it's going to turn out the Fed has to go further.
So, Andrew, how much further then do you think the Fed is going to have to go? If 5.1% isn't high enough, how much higher do you think is necessary?
Well, so the Cleveland Fed has a new survey of inflation expectations of consumers. They asked ordinary people kind of how much of a wage increase would you need over the coming year in order to compensate you for the cost of living? And the answers in those surveys are on the order of 7 to 8%. That's pretty consistent with some other measures too. The nominal wage growth is very strong right now, 3 percentage points above the pre-pandemic levels. So if you ask me, where does the Fed need to go if the economy continues to be strong next year? I'd say 6, 7, maybe more. We'll see. We're in uncharted waters here in the wake of the pandemic. So we should be really careful here just to recognize that there's a lot of distinct risks, and we should be alert to those risks.
I just want some clarity. You don't think the Fed will go to 6 or 7%, do you?
I think there's a very good chance of that. In fact, I will tell you, a year ago, I was on this program at a time when most professional forecasters and market investors thought the Fed would only hike once or twice this year. And I said a year ago that I thought they might have to go up to 3 or 4 or more. And you and your colleagues were kind of in shock. And I think, but looking back, it was clear the risks were to the upside. So I just want to say again here, we'll look forward over this coming year, and they could go in the other direction. But right now, I don't see the risk of recession as nearly as significant as the possibility that the services inflation continues to be far higher than the Fed's target.
We'll check the tape, man. We believe you, absolutely, Mr. Levin. But I'm curious, there are some who feel the Fed may be forced to call it a victory around 3.5% to 4%. Do you think that's possible?
I think if inflation stays high for another year, and high here could be 4%, that would still be twice as high as their target. Then we get into a presidential election year, and the Fed's going to be in a tough spot at that point a year from now. Are they going to be willing to tighten a lot further and potentially cause a recession in advance of a presidential? That would be a really tough decision to make. So the possibility that this gets further and further entrenched for the next several years is definitely part of the concerns that I have.
So, Andrew, where do you stand then on the labor market? How much job loss or weakening we need to see on that front, if any, in order to get inflation under control and to be in a better position than we are today?
Okay, that's a great question. And I think one thing that's important to recognize is that when the job market's growing steadily, and right now, the what we call prime age workers, which are people in their 25 to up to around 55 or 60 years old, most of them are back to work now. The ones who were working before the pandemic now, most of them are back to work. In that sort of environment, we shouldn't be expecting to see job growth of 200 or 300 or 400,000. The normal kind of job growth that you need to have to sustain the labor market is probably more like 100,000. So my expectation is we should and almost have to see job growth declining over the next 6 months, 9 months to around 100,000. And we should not view that as a tightening of monetary policy or a sign of a recession. It's just going to be the normal pattern of, at this stage of a recovery, what happens to the monthly job numbers.
What would you like to hear from the Fed chair today?
If he keeps reinforcing the message that they're not done and that they're willing to do what it takes to bring inflation back, they got to be careful. They ideally would like to avoid a recession, or at least a severe recession. They should take a balanced approach to both parts of their legal mandate, maximum employment and price stability. But given that services inflation is heading still in the wrong direction, we need to hear from Chair Powell reinforcing, underscoring that commitment month to month to month to month until we really see progress on this.
Andrew, when it comes to raising rates, how quickly the Fed could potentially do that? You said that maybe we'll see somewhere around 6 to 7% outside, or I guess looking ahead to next year, the next Fed meeting. Are you expecting another 50 basis point hike, or how do you see them getting to that potential 6 to 7%?
I think that's a good question. So they're alert to the data coming in, and some of the data around the holidays is harder to read. But I think that probably it would make sense for them to make another 50 at the end of January, given what they've just shown in their dot plot today. I think if they didn't do another 50, it might undermine their credibility. But going forward beyond that, they could start moving to 25s. Or if the service inflation data continue to come in stronger and the nominal wage growth going into the new year looks like it's picking up, even accelerating, then they'll have to keep doing 50s for a while. And again, the communications here is really critical to keep updating the public and the markets how the Fed sees all of this.
Andrew Levin, always great to have you. We're going to have you back here in order to follow up on today's projection. You were right last time. We'll see if you're right this time around. Thanks so much for joining us this afternoon. All right.
We've actually seen some deals announced this week. Biotech firm Amgen buying Horizon, PE firm BDT Capital Partners taking grill maker Weber private, and software maker Coupa bought by Thoma Bravo. That one's been speculated upon for a bit. But the flurry of deals may not herald a shift in appetite. For more on their outlook on mergers and acquisitions heading into the new year, we have Vito Sperduto, RBC Capital Markets co-head of Global Mergers and Acquisitions. And whew, it has been quite a year, hasn't it, Vito? So are things shifting at all? I mean, that's just anecdotal, right, that we've had a couple deals this week, but still.
No, and I think when we'll talk about it, I think these transactions highlight some of the trends we're seeing and some of what we're looking forward to in the coming year. I mean, it's certainly been a tale of two halves if you look at the first 2 quarters of the year versus the second half of the year. I mean, keep in mind, the volumes we've seen the last 2 quarters on a quarterly basis is lower than we typically see, and you'd have to go back well before the pandemic to see these types of volumes. So we're going to end up the year at about probably 1.6 trillion in the U.S., which is well down from last year, off about 43%. But if you put it in perspective, it's only off about 10% where the pre-pandemic levels were. And you saw in 21, when the market just was exceeding expectation, it was primarily driven by the fact that there was so much pent-up demand. And you had, when the market reopened, you had everybody accessing the market. So if I look into 23 right now, certainly the first quarter is going to be challenged. I think all of us are looking forward to the news later today and try to see the tone that's going to be put out there by the Fed. But until there's some stabilization there, it's going to be difficult to get a regular trend going. I do think the second half of next year is going to be extremely strong, primarily because we're going to see a lot of deals that people are planning to bring out. And so if I look at our own pipeline right now, there is a significant amount of volume that's expected in the second half of next year. But, as we look at our team is working as hard as they ever have because there's many clients preparing to hit the window when it opens. And so if I look at next year, I certainly think it'll be at least in line with what we saw on average pre-pandemic and likely higher because you're going to see some deals that didn't happen now flow into next year.
I think a lot of folks are waiting for a series of big deals in the tech space, notably in software. Some of these valuations have been absolutely hammered this year. Is that one sector that investors should look to that will see a big pickup next year?
Tech is always leading the way from a M&A volume perspective. If you look at the LBOs that have happened this year, I think a little over 35% of them have been software and tech focused. I think the deal that you just mentioned earlier in terms of Thoma buying Coupa is a great highlight of what you see in the marketplace. Certainly a darling early in the pandemic and was trading at levels well above where it is now. At the start of the year, it was almost double what the deal price is today, and it had gotten beaten down during the year. And you see someone like Thoma, who just raised and closed on 3 funds totaling over $32 billion in new, fresh capital, executing on a significant transactions. Now, if you dig in, though, part of what you're seeing is that they're finding different ways to get the deal done. So versus the traditional bank financing you'd see for the debt, they went to direct lenders. So 19 parties provided $2.6 billion worth of capital. That's pretty significant. They did $3 billion through direct lending when they bought Anaplan earlier in the year. And so that marketplace has taken prominence while the traditional financing sources aren't really available with the volatile environment. Now, I do expect it to go back. I mean, if you look back at the start of the pandemic, you saw the private equity firms doing a lot of pipes in the public companies, and they were doing alternative deals. As soon as the market came back and they could do traditional LBOs, they went right back to that. Right. And so there's too much capital to spend not to go back to that market once it reopens, which I think second half of the year of next year feels like it's going to be a good time period.
Less of an easy money environment. Deals for some of the acquisitions that publicly traded companies are making, they're going to be scrutinized more because the investors are going to be looking across how much of that money is going out the door and what growth or what accretiveness some of those deals carry as well. And so what role will the financing of these deals also play in 2023?
Yeah, I think if you're, Brad, if you're referring to sort of what public companies are doing, I think if you look at someone like an Amgen and Horizon, it highlights the fact that you have a party with significant amount of capital on their balance sheet. I think they have over $11 billion of cash on their balance sheet. Now, obviously, some of that sits in foreign jurisdictions and it's hard to access, but they're also an investment grade borrower. And they're also a leader in their sector. And so parties are going to look at that. And those are the parties that are going to do well now in a volatile environment. They're able to do deals. We often track cash on balance sheets, and we look at the S&P 500 as an indicator. Pretty interesting. If you go back to the 08-09 credit crisis, the S&P 500 had about $1 trillion of cash on their balance sheets. It peaked at about $2.1 trillion at the end of 21. Right now it's at 1.9. So it's almost double the amount it was before. And I think CEOs have tended to be more conservative. They've wanted to be more liquid. They don't want to get caught again like they did in 08-09. And if you look at the sectors where have the largest cash piles, tech and healthcare. If you look at the sectors that are the most active from an M&A perspective, tech and healthcare. And so it just works in that fashion. And I think we're going to see a fair bit more from a technology consolidation perspective, but then also biotech is a hot sector. I mean, Amgen's buying access to a certain number of products that they covet.
Yeah. Vito Sperduto, RBC Capital Markets, co-head of global mergers and acquisitions. A lot to track going into next year. Thanks for teeing this up for us. We got a lot to keep our eye on. Thanks.
Thank you for having me.
Well, this morning's inflation reading came in softer than expected, up just 0.1% from the previous month. We did see stocks pop on the release. Well, now it's over to the Fed, which looks to set to hike rates again tomorrow, with a downshift of 50 basis points, widely expected. Approaching a new year with recession bets rising isn't what anyone wants, but the Fed and Wall Street do seem to be on different pages as to how 2023 is likely to play out. Morningstar's weighed into the debate with its outlook. It sees the possibility for stagflation and says the emphasis for portfolios should be planning over prediction. We are joined by Marta Norton, Chief Investment Officer for the Americas at Morningstar. Marta, good to talk to you today. Let me just first get your reaction to what we saw in the market today. We saw that CPI print come down, Dow futures popping on that. Are we back to kind of getting ahead of ourselves before we hear from the Fed tomorrow?
I think that's always a risk, Akiko, and thanks so much for having me. I think that's always a risk when we have huge market reactions to a single data point. Now, I do think there's some sense to a celebratory dance. The Fed has said that it's watching inflation prints closely. It's looking for tangible signs that we're at an inflection point in this war against inflation. And when you add November's print on top of October's print, and you see some of this cooling or some of this kind of pullback from these peak levels of inflation, I think there's good reason for the market to say that, potentially we could see the Fed back away from some of the extreme moves it's made on the rate side this year. But I do think that we want to be careful about extrapolating too much from one or two data points.
And we know that's the same feeling that the Fed has. They clearly want to see more consistent data that inflation is cooling. But we did see the headline number, as you mentioned, there 7.1% for headline inflation, 6% for core inflation, and that's versus the 6.1% that was expected as well. For people who are trying to sort of plan for what to do with their portfolios, then what should they be looking at right now?
Well, I think there's two major questions, Rochelle, that the market still needs to grapple with. One relates to the labor market and seeing some cooling there, which hasn't really taken shape the same way that we've seen some pullback on inflation prints. And then I think the other thing that the market needs to grapple with, investors need to grapple with, relates to the impact of these Fed moves on the overall economy and what that means for a recession. So from our perspective, from the perspective at Morningstar, the range of outcomes remains fairly wide. And where we see inflation level off in the long run, what we see happen on the economic side in terms of a recession, those are sources of volatility for the market. And we don't necessarily have answers for those. So when we talk about planning over prediction, what we're really thinking about when it comes to portfolio construction is creating a range of different asset classes that can respond differently to different outcomes. So imagine an environment where inflation remains sticky. Tips in some areas of energy might, continue to make sense in a portfolio. At the same time, if you start to see disinflation and a cooling as we're seeing in inflation, we could start to look at some areas, in the value spectrum of equities or within fixed income that could do reasonably well in those environments. So it really makes sense in our view to have this kind of spectrum of asset classes that can do well in a range of different environments.
How do investors determine just what kind of exposure to have? I mean, you just put it up 4 big scenarios. It could really go in any direction.
That's right. So uncertainty remains very high. So I think that the real wisdom here is not to plan for one particular environment. It would be really tempting if you start to see the market recover, you start to see these inflation prints start to cool off a bit, to really go hard into risk assets. So loading up on all types of risk, whether that's high yield bonds or whether that's equities across the risk spectrum. And our perspective is that it makes sense to take some caution and to move a little bit more slowly than you otherwise would, and not say that this is an all-in, putting all chips into the center of the table type of environment, but rather thinking about how is this asset going to do relative to that asset. And that's where the real nuance of portfolio construction comes into play.
And Marta, just quickly, in terms of some of the geopolitical, some of the international impacts that might be having on U.S. portfolios, anything that people should be keeping an eye on or that might be under the radar right now?
Right. I wish I could say that question around international is an easy one to answer, but we also see some kind of mixed signals overseas as well. So valuations, the price that you're paying for the assets that you're getting, they look pretty attractive, whether you're looking at non-US currencies or whether you're looking at the actual local assets. And so I look at areas like China, I look at areas like the UK, like Germany, European financials broadly. All of those areas look pretty attractive to us when we take into account both the currency and the local assets. But as you note, there is some uncertainty over there when we're talking about the geopolitical tension, when we're looking at things like how the European energy crisis could play out, when we're thinking about some of the troubles that the UK has had. And so from our perspective, it makes sense to start to be overweight some of these areas. But again, to do so with a bit of caution or with a bit of kind of a steady hand. So not going kind of to a full overweight, but having some exposure because the valuation suggests that we should.
A cautious balance everyone should take then. Morningstar's Marta Norton, thank you so much for joining us this morning. An interesting finding out of Redfin's predictions for home sales in 2023 released today. Now, home prices will see their first year-over-year decline in a decade, and home sales will fall to their lowest level since 2011. We're here with more on the future of housing is Mark Norman, Associate Dean of the Schack Institute of Real Estate at NYU School of Professional Studies. Good to have you on. So I first want to get your take on these findings from Redfin. Are you seeing trends going in that same direction?
We are seeing trends go in that same direction. Thank you for having me, by the way. But at the same time, we have a supply problem with housing. So there's still so much housing that's out of reach for Americans that we'll see the price declines. But I think the income gains that we're seeing lately still aren't keeping up with the prices that we're seeing in the market, in most markets.
And as you mentioned that supply issue then, how much imbalance is there between the buyers and sellers' demand and selling right now?
Yeah, I mean, it's really interesting because there's been this sort of uptick, but we, for the last 20 years, have underbuilt the housing. I think the housing crisis actually exacerbated that. In 2008, right, we saw the sort of demand go down, but it never came back in terms of supply. And now that we're in this inflationary environment, I feel like we're in a place where the housing can't keep up with the demand. So even though we see this decline in prices, I don't know that we see more people that can actually afford houses. And that's really the issue right now.
Because there really was that fear coming out of the housing crisis that led to the underbuilding, really not sure what was going to happen with the housing market. But I want to ask you, in terms of policy-wise, is there something, whether it's zoning or other ways, that could help perhaps alleviate some of these stresses?
Yeah, I mean, I think there are a couple of things, and I think it's interesting because it's less on the federal level and more on the state and city level, and that's trying to increase that supply and also trying to sort of ease some of the restrictions on builders so that housing can be built quicker. So that at our current capital markets conference, the mayor of New York announced, a number of different ways that they might work to speed housing. We're also seeing in places like California this switch to allow multifamily units in single family neighborhoods. And then we also see alternative lenders coming in to say, we'll actually, evaluate buyers in different ways than the traditional market might. So maybe not looking at a steady income over time, but creating a space so that those gig workers and contract workers that might have steady incomes, but not as legible as a standard worker might be able to have access to housing in ways that the banks aren't really underwriting.
And that could be a real game changer because we know how tough it is for first-time home buyers at the moment. And even when you look at mortgage rates, we're seeing that the average 30-year fix has roughly doubled from the start of the year. What are your expectations going into 2023 in terms of affordability and what we might see with mortgage rates?
Yeah, I mean, I think mortgage rates are going to stay high. And actually, when I say high, they're going to go back to probably what's a new normal, right? I think we really got used to a low interest rate environment over the last 12 years. But if we look at the last 30, we're actually coming into a place that's more in line with traditional mortgage rates. But I think we have to get used to that. It's going to take probably a number of years for prices and housing stock to adjust to that kind of mortgage environment. But the 6 to 7% interest rate isn't an anomaly unless you're just looking back at that last 10 years. I think one of the other things, though, is that we don't build starter homes in the way we used to. So homes got bigger, prices increased, and the market met it there. But that really put housing out of reach for a lot of first-time buyers, especially.
And Mark, I do want to ask you about the rental market, because obviously renters also being squeezed as there isn't enough supply for them to be able to get into houses. What are your expectations there? And any sort of policy things? We know that in parts of Asia and Europe, there are some regulations on rent growth that could help people. Anything that potentially could help here in the US?
Yeah, I mean, once again, it's so city by city in the sense of, right, California, New York have rent stabilization programs that might keep the sort of inflation in rents in check, but also might constrain supply. Other places you don't have those sort of limitations on, how rents can increase. But you also, in places like Texas, actually have that increasing supply that keep prices relatively stable, except of course hot markets like Austin and now Dallas. But it really is a matter of supply. And to the extent that we don't have the supply, I think we need the supports. We're also seeing some of those supports diminish, right? So the eviction moratoria or the pandemic programs that helped renters get through this period are going to be expiring. So I think we're going to see a little pain in the housing markets for a while, especially among the low and moderate income renters and borrowers for mortgages.
Tough times ahead indeed. A big thank you for joining us, Mark Norman, Associate Dean of the Schack Institute of Real Estate at NYU. Thank you for bringing your insights.
Investing with a twist. It's a simple yes or no when it comes to Kalshi, a CFTC-regulated exchange that allows investors to trade events like stocks. The group has offered over 2,000 markets since opening the exchange in July 2021, with over 10 million contracts traded a month. Let's look ahead to 2023 with Kalshi's co-founder and CEO Tarek Mansour. Tarek, good to see you in studio here. Before you even talk about next year, how does this platform work?
Yeah, it's super simple. So Kalshi is it's a CFTC regulated exchange, the same thing as the CME or ICE, who owns the New York Stock Exchange. It's an exchange. The only difference is that we don't trade on traditional assets like equities or commodities or other. People are trading an asset called event contracts, where the underlying is not your typical stock or bond. It's the occurrence of non-occurrence of an event. So it could be on things like economics, like inflation or Fed decisions, geopolitical events, climate and weather, and a variety of other things.
So when it comes to things like we talk about all the time, right? Like CPI coming up this week, the Fed decision coming up this week, the predictions, I believe, for those two events are pretty much in line with the market. How often do you see divergence from conventional wisdom or conventional markets and what you see on Kalshi?
It's actually pretty phenomenal. I was looking at the numbers. So for inflation, you have two main numbers that Wall Street looks at today. There's a Bloomberg Economist survey that comes out, I think, 1 to 2 weeks ago. And then there's the Cleveland Fed Nowcast that came out at 10 a.m. today, I think 30 minutes ago. So right now, Nowcast is at 0.47%, and the Kalshi markets are forecasting 0.3% for November inflation. So there's quite a bit of divergence, around 0.2% difference. And so we are forecasting lower than expected inflation, lower than what the market is expecting. And just for, I guess, the sake of credibility, we've been more accurate 10 out of the last 12 times than any other data points that Wall Street looks at today.
What is the appetite, or is there an appetite among your end users for being able to look at even like cryptocurrency events? There have been some significant ones, of course, with FTX most recently. If there were other events, halvenings, or some of the expected occurrences that they could have a position on, what would that look like in the future?
Absolutely, yeah. So I think there's two ways that this has manifested. Our users did ask us about halvenings or, forks or these types of sort of core events that impact the ecosystem more broadly. And the second, actually, funnily, the second use case that for a year a lot of our users have been sort of pounding the table, we want this, is being able to short cryptocurrencies easily. Well, because today it's not super easy to do that if you're not crypto native, so to speak. We have not touched crypto yet as an exchange. We can talk a little bit about this. Our ethos has been fully regulated from the start, and we're going slow and steady with respect to new assets.
With regards to what happened to FTX, what, if any, impact has that had on your business?
It had no impact. So for a little bit of background, so Kalshi is a fully regulated exchange. we're regulated by the CFTC, the federal government. We actually took 3 years to get regulated up front before launching any market. And that has been sort of, Luana, my co-founder, and I we've been very, very focused on doing things right from the very beginning. And it's really interesting because it's really in those times that those types of decisions actually bear an impact. Because, a year ago, sometimes you question, what is the purpose of regulation? What is the difference, right? When you see a lot of exchanges, notably FTX and others, climbing the climb that they've had and a lot of volume and, there's a lot of zeitgeist and excitement, people don't really care about regulation those times. It's really in these times when people come to you and ask, where is my money? And you tell them it's in a CFTC-regulated clearinghouse in a segregated member account with proper oversight and audits from a federal regulator, that people care and people feel comfortable. And, our growth has been better than ever and people feel very safe keeping their customer funds with us.
So just to sort of break down and explain what you're talking about. So you guys are a CFTC-regulated exchange, and then you have a clearinghouse that clears your trades. The clearinghouse is actually an FTX-related entity, correct, but because it's a regulated entity, it's still operational and it's not seen the same sort of spillover
exactly
that some of the other FTX entities have seen.
Precisely. So it's been really interesting. So the entity is LedgerX. LedgerX was acquired by FTX back in fall 2021. LedgerX has been operational for 7 years now. So LedgerX, interestingly, is one of the, or maybe the only, I don't have the full data, but I know it's one of the very few fully regulated entities that FTX owned. So contrary to popular belief, even FTX US is not regulated like LedgerX. LedgerX is regulated by the CFTC. They have balance sheet requirements, customer fund segregation requirements. And as you see, pretty much all the FTX empire went into bankruptcy. LedgerX is one of the caveats. LedgerX is still fully operational. They're serving their customers as usual, and the executive team is there as the highest level of integrity. So it's been great working with them.
What are some of the most popularly traded event contracts that you have on the platform right now, and how does that build up the target audience that you're even expanding into? Because are you in beta right now or emerging from that right now?
Yeah, so we're launched. The growth has been amazing. A lot of the customers we're getting is traders, Wall Street traders. Some of them are individual for their own personal account. Others is smaller funds, up to some of the bigger funds that you might be familiar with. I think so currently today, actually, our most popular market is inflation. And it really ties to usually where trading volume is, it's where people's worries and concerns are. And I think inflation has been really top of mind for a lot of people. It has had a lot of impact. We've had a peak this year. We're starting to see the sort of tapering. And the interesting thing about inflation in terms of differentiated product is that there's no easy way to trade on short-term inflation today. The only way is to set up an ISDA with a bank. Super expensive process. There's lawyers involved. Takes a few months at least. And on Kalshi, you can just sign up a few minutes and you can put on the trade. So it has been a very exciting market.
Finally, just quickly, I wanted to ask you, not directly related to FTX, but just what we've seen in the market, right?
Sure.
In the public and in the private markets. You guys are a startup. Has it been tougher raising capital? What's the environment like right now?
Yeah, so we're very well capitalized. We're very lucky. We've raised, much, we have close to 10 years of runway right now as a company, very healthy financials. What I would say is what we see from peer companies is obviously the private market has tightened. We have seen kind of an unbelievable wave at the end of 2021, beginning of 2022. Capital was very, very cheap and it was very abundant. And you could see that a lot, especially with crypto companies. So peer crypto companies were raising at record valuations. I do think that the private market's appetite has largely lessened now. And people are looking at a lot more closely at valuations. We are not raising, we're not in the market, fortunately, but for some people that are in the market, it's definitely tougher.
Yeah, it's a good place to be for you guys. All right, Tarek, good to see you. Tarek Mansour is co-founder and CEO of Kalshi. Appreciate it.
Let's get you up to speed now on some key economic data out today, excluding food and energy, the core PPI, which measures what companies get for their products, essentially up 0.4%. That is hotter than the expected 0.2%. A 38% surge in wholesale vegetable prices helped push the food index up 3.3%, the same number by which energy costs declined. Now, the consumer price index is due out Tuesday morning, so we'll get a better glimpse. But we also got an update today on consumer confidence. The University of Michigan index rising to 59.1 from 56.8 in November, far better than the expected 53.3. Joining us now to discuss this and the state of the private equity market is Scott Sperling, Thomas H. Lee Partners co-CEO. Scott, nice to see you. Let's talk about that economic data we got out this morning. If you're the Fed chair, how do you look at it?
I think you remain concerned about inflation as something that will be more persistent than we like. We know that inflation is one of the more insidious problems in the economic sphere. People talk about the toothpaste getting out of that tube and the impossibility of getting it back. I think when we look at the various elements of inflation, one has to continue to be concerned about wage push inflation, about the fundamentals behind some of the key commodities and inputs into our economic activity, principally policies in the United States having to do with not just the energy portion of oil and gas, but also the fact that those are major feedstocks for a lot of industrial products. So I think that there are fundamentals that one has to be concerned about. The thing that has been holding inflation back to some extent has been the fact that I think people anticipate a recession. Economic activity in many ways has slowed down in a number of sectors, and that is putting a little bit of a cap on it. How the Fed balances those two things, I think, will be really interesting. It may be that the market's not wrong in the sense that the Fed will ease up on the amount of interest rate increases that they do at each of the appropriate meetings, to that 50 basis point next time, maybe to 25 basis points after that. But we may have these higher interest rates go a bit higher than the market's currently predicting, and they may sustain for longer than the market is currently predicting.
Scott, when it comes to inflation, are you confident that we have seen peak inflation? Some of those stickier parts of inflation, how long do you think that is going to remain?
I don't think we fully absorbed, the wage push inflation that we're seeing. You can look at some of the contracts, particularly some of the new union-based contracts in transportation in particular, and those are reasonably high rates of increases. They may be justifiable given inflation of the cost of everything, but we should not underestimate the impact that will have on sustaining higher wage inflation rates. The amount of spending that we'll see into things that increase productivity is going to be very important in terms of managing through some of these things. Labor shortages are still a big issue in a lot of different parts of our economy. Automation is going to be really important in helping to close some of those gaps, particularly for less attractive types of activities for humans. And we're seeing a lot of that occur. But we're going to have to be really careful as we manage through this. And again, the fundamentals of things like regulation tends to raise the cost of doing business. That has increased dramatically. And obviously the energy policy, when we're talking about carbon-based fuels, particularly in the United States, but also around other parts of the world, may be problematic from that aspect.
I know nothing gets you out of bed, Scott, like an Elon Musk tweet. He just now says if the Fed raises rates again next week, the recession will be greatly amplified. Now, again, higher rates bad for Tesla. They're down 54% this year. Set that aside. What do you think about a recession and about that prediction?
Well, I think there are very, very few people at this point who are not predicting a recession sometime in the next 14 months. I think the most recent economist survey, 100% of the economists are predicting that. Now, that may be the best news we can have because it's not likely that 100% of the economists are technically right. But nonetheless, let's assume that there's a recession. I'd also look to, a comment I think Larry Summers made that I don't know why we talk about soft landings because we haven't had one. I think that's a paraphrase, but I think that's actually accurate, that we tend not to have soft landings. They're nice in concept, but normally it's pretty rough. The question is duration. And the more we get ahead of inflation right now, I think the shorter the duration of the economic problems that we might have will be. The markets probably still have another leg down or two. There will be some corrections. There will also be some great buying opportunities there. I know that as we look at opportunity sets in the private markets, they're becoming increasingly attractive. There has been a major migration, as you know, in our economic activity to the kinds of companies that have superior business models, more reliable revenue streams, the so-called annual recurring revenue type things, and business models that tend to do better in economic downturns. We are seeing more economic activity come back to the United States, also back to Europe. The nature of investment that we're going to be making in things like semiconductor are crucially important and will be a source of economic stimulus. So I think if we can get inflation under control and we get through the next 12 to 18 months, then I would hopefully see a strong uplift after that.
All right, Scott Sperling, great to have you. We hope to have you back here on Yahoo Finance. Thanks so much for joining us this afternoon.
Let's broaden it out now and turn to what's driving markets both here and overseas. It's inflation trends and Fed policy continuing to animate most early market moves this year, this morning, but also, of course, watch for the effect of China's reopening on to determine how the remainder of the year shakes out. Joining us with more is Luca Paolini. He's chief strategist at Pictet Asset Management. Good to see you, Luca. Thanks for being here. So we were earlier talking about the PPI numbers that we got this morning that were hotter than anticipated, which kind of maybe shakes the thinking, the conclusion that inflation, the rate of inflation is slowing down. I don't know. I mean, what do you take away from that?
No, I think we're reading too much into these monthly figures. I think the trend is still down. Energy prices are going down. Probably rents are peaking. Probably even wage inflation has peaked already. It's a very volatile series, and the trend is down. And I don't think that the market will read too much into this, to be honest.
As you look into next year, what's the biggest risk for markets in your view?
I suspect that we're going to talk more about growth and less about inflation next year. I think the potential for a recession, I think, is probably bigger than the market expects. So I think the major discussion or debate for next year, I think, is going to be growth, and I think inflation is going to, the inflation risk probably are going to fade a little bit. And then obviously the big story for me is China. The reopening of China, we have seen a big rally in Chinese equity prices. So that's the two, I think, the two kind of, the potential, the positive side and the negative side in terms of risks.
So given that, how much dispersion of outcomes is there for next year? I mean, I think most of the folks we've talked to, most of Wall Street thinks there is going to be a decline in stocks, in U.S. stocks at least next year. But how big of a decline, I guess, is up for some debate. How are you thinking about it?
First of all, I'm surprised by the consensus that seems to expect a decline in equity prices, which is very unusual. And this makes me think that there is actually upside from that. We also believe that stocks in general will be under pressure, mainly because we haven't seen the full decline in earnings that we expect. So nominal growth will be much weaker, margin will be under pressure. So there will be potentially an improvement in valuation, in PE ratios, but probably not big enough to create an environment for a strong rally in equities. But we expect some positive returns, but still a weak year for equities going forward.
How do you imagine stocks will come out of the gate next year? Because it has been, of course, a weak year this year, and theoretically you should see some buying in January, no?
Yes, but I think the market has been a little bit in the last few months actually been very kind of, there was a big rally coming from what? From very low expectations. So now inflation is down. I think also the economic data has been slightly better than expected. My feeling that there has been already this kind of rebounding sentiment, and there will be disappointment in the first part of next year. That's why we expect equity prices to be under pressure.
Does that go for Europe as well? It seems as though thus far some of the, I mean, it's early in the winter, but some of the worst case scenarios for the energy crisis in Europe have not yet been realized. There's still time, I know. But how are you thinking about that region?
Well, I'm based in Europe, and we are all kind of surprised by the fact that the European economy is pretty resilient. You have seen also kind of a pickup in some kind of consumer confidence indicators. Inflation is still high, but there is feeling that it's probably falling. I think is a number of factors. I think the fact that natural gas prices have been falling significantly has played a big role. As we all know, the gas storage level is very high, so I think this winter will be probably fine. But I think that's also, by the way, in the U.S., that the economy has showed probably more resilience than we expected. And we still don't know if the bad news will come later on, or there is a genuine underlying strength, especially in the private sector. So that's something that obviously we'll find out sooner rather than later.
You mentioned China reopening, and of course that's a key thing all investors need to watch next year. But wouldn't that be a massive inflationary event and potentially bad for markets?
No, I don't think so. I think obviously the Chinese economy is more than 20% of the global economy, but we're not talking about Chinese growth booming. And we expect China growth to accelerate to 5%, not 10%. So I think at the margin there will be a negative impact on inflation, but I think it is probably fully offset by weakness elsewhere. So I don't see the reopening in China as a major inflationary force for next year.
Well, you will indeed be watching it. Luca Paolini, Chief Strategist, Peak Day Asset Management. Thanks so much. Have a great holiday season.
And as we talk about what's happening in China, what's happening in the U.S., the common theme is that things are slowing down from an economic perspective as the world economy faces one of its worst years in 3 decades. Our next guest says we're on the cusp of a loose recession. That's Morgan Stanley Chief Economist Seth Carpenter, and he is with us right now. Seth, it's great to see you. Obviously, there is a lot of glum talk that is out there. First of all, what does a loose recession mean?
What that means is when we look around the world and we think about the global growth rate, there are lots of countries, especially EM countries, that just are growing more rapidly on average because they're starting from a lower base. And so to use negative growth to define a recession globally sort of overdoes it a little bit. At the end of the day, though, it ends up being semantic. It's something a recession, if we're growing at positive 0.5%, if we're growing at negative 0.5%, that matters a bit, but we're in a situation where things are slowing down so much, the distinction between recession or not is going to be a little murky.
Seth, you're not looking for much growth in the U.S. next year. Walk us through what that growth looks like. What does growth look like in the first half of next year, for example?
Absolutely. So slowing down in the United States is, as it turns out, the objective of the Federal Reserve right now. They are raising interest rates, and we'll have another meeting coming up next week. They're raising interest rates precisely to slow the pace of spending and to get the economy to slow down. We think they're going to be successful, right? We see a housing turnover. We're seeing some hints that durable goods spending is starting to come down. That's what they're looking for. So we think we get a slowdown. If you take jobs, for example, the last print was still pretty solid at mid 200,000. We think that continues to come down and eventually starts to get below 100,000 per month. We think it stays positive on average. So again, skirting a recession, but it's got to come down from where it is now if the Fed is going to be successful in bringing inflation back down.
So real quick, is GDP negative in the first quarter and the second quarter of next year?
We don't think so. We think it's going to be positive. We think it's going to be, about 0.5%, something like that. So skirting a recession, just barely avoiding a recession. We're still cautiously in the soft-ish landing camp.
So the Fed can say one thing and Powell can put out one message through a speech, through testimony, whatever that may be, but the markets can read something totally different and decide what they want to think about what Fed Chair Powell and some of the other committee members are saying. Does the Fed have a communication issue at this point, or is it how the markets are actually digesting what the Fed is signaling?
Option D, all of the above. We are in an extraordinarily difficult time to predict what's going on, to understand where the cross currents are. The news coming out of China that we just discussed, that's a rapidly developing story that has lots of implications for markets. And I think there really is inherently a lot of difficulty in understanding what's going on. When folks from the Fed talk to me about exactly this question and they say, what should we be thinking about for communication? I say, and at first they think I'm being flippant, but I say you should be as clear as you can be, but don't be any more clear than that. And there's just so much uncertainty right now. I think they need to be cautious in what they commit to.
Yeah, there's almost a danger of over-speaking. And I guess Jay Powell took that lesson to heart at Jackson Hole this year. But people are going to react how they're going to react. I do want to broaden out the conversation a little bit and talk about China, talk a little bit about the Eurozone, where we just got a better than estimated revision in GDP this morning. Sort of how lumpy is this going to look around the globe? Are there areas that are really going to hold up better?
There are almost surely going to be areas that will hold up better, but it will be messy, it will be lumpy, and there will be a whole set of confusing news flow. So for China, the news that we were just discussing is about what's going on with reopening. And I think one of the questions you asked is, what does it really mean? If there are restrictions lifted in some areas but not others, will people know what to do? I think on a global economic scale, there's also the question is, when the economy opens up, what does the demand look like there? And we know that households have been sort of locked in for a long time. The pent-up demand is probably more skewed towards domestic spending than it is historically, more skewed than typical towards services. And as a result, there's probably going to be less pull in terms of imports into China from the rest of the world. So I think the normal spillovers we get from a China acceleration are probably a little bit smaller this time than they have been historically.
Well, and the other question I would ask is, as we see sort of that last big economy reopen, have we learned the lessons from here? In other words, here we had all these pull-through effects and all of these strange effects that are now recorrecting and renormalizing. And we sort of knew it was coming, but we also sort of were surprised by it as it came, right? That we have seen these strange dislocations. Have we learned the lessons? Can we expect that in China as well?
I definitely think there are going to be lots of frictions as things open up again. Inflation has been actually quite low in China in contrast to a lot of the world where there's been opening up. And so I think there can be some frictions as people go back to spending and as they try to sort of increase the amount of services production that goes on there. So whether or not we've learned the lesson is in some sense off to the side. The fact remains, it's just really hard to open up an economy after a pandemic.
Seth, let's go back to the U.S. Is U.S. consumer spending just headed into a dark place? Are you talking about a job market slowdown, a potential recession, inflation is still high, and that is just a couple things on a long list of, I would say, even a low savings rate facing many households?
So there are lots of different cross currents. I would say one thing, when it comes to inflation, what we already see in the data is that consumer goods inflation is coming down. We've seen several categories of consumer goods where the month-on-month change has actually been negative. Automobile prices, used auto prices actually have come down for the past 2 months in a row. And so we are starting to see disinflationary effects there when it comes to consumer goods. Housing is clearly important when it comes to rents. That's rents or owner's equivalent rent, 40% of core CPI. What we know in terms of the new contracts, new leases, is that the rate increases for rents, that's actually stopped and is starting to level off. So in that sense, I think we are starting to see the beginnings of this disinflationary trend that we expect to happen over the course of next year.
All right, we're going to do a little deep dive on the commercial real estate market now and breaking it down in 3 distinct categories: multifamily, industrial, and office. 3 markets in one region really stand apart from the rest: Nashville, Tennessee, Raleigh, and Charlotte, North Carolina. You have this entire massive country, and yet these are the 3 in one particular very isolated region. All 3 cities are considered cadre MVPs, or the triple crown of real estate, if you will. Why? Well, let's talk about that with Ryan Williams. He's the Cadre co-founder and CEO who joined us now in studio. That was very interesting information to see why this small region, we have this whole country, most of which saw enormous growth in 20 and 21. What stands out about those 3 markets and that region?
Sure, and thank you for having me. There are really 2 key drivers. One is demand, second is affordability. Demand, job growth, number of people making trips, leisure, and affordability, the cost to live, the cost to visit, the cost to reside in those 2 markets. And so those are the 2 variables that made those 3 cities our triple crown.
And how do you quantify that?
Sure. We quantify a lot of it using third-party data. So census data, a lot of demographics data, how many millennials moved in, moved out. We also have some proprietary transaction data. We underwrite real estate around the country, and we get an insight into which properties are performing, which ones are not. So we know what pricing is in and around certain markets as well. And then we look at mobility data, geospatial data, and aggregate everything. And we say, which of these markets around the country on a relative and an absolute basis do we feel are growing the most and are most affordable? That's the magic intersection.
Okay, so let's take the region out and those 3 cities out and just talk about the 3 sectors of commercial real estate, which we had up to begin. Which has the best outlook in the economy that we're headed into?
Yeah, we are investors across an array of sectors, sure. But we do believe in focus, especially at this point in time when affordability is more challenging than it's ever been. More people are being priced out of buying homes given where rates are. Yeah. And so out of the multifamily, industrial, and office sectors, we like multifamily the most. It's one of the most resilient sectors because people always need somewhere to live. And at a time like this, people are renting more. And so what we're seeing is renewals at all-time highs around the country. And more and more people saying, you know what, I'm going to kick the can on buying a home. And what we're doing is we're buying more apartment buildings, multifamily buildings, letting people buy fractional stakes versus putting up money for a mortgage when mortgage rates have gone through the roof.
Now, I talked about those three cities in that region that stood out. What else stood out about the lists is there was no New York, there was no Los Angeles, no San Francisco, no Chicago, the biggest cities in the United States and the biggest metropolitan areas. Why so? Why are they absent from those lists?
Affordability. That's the name of the game. I mean, in New York City, for instance, where I've rented for a while, rents have been at an all-time high, despite the lack of demand and so many employers moving outside of the city. LA, Chicago, same dynamics. And so because these places are still relatively less affordable than some of the other markets and geographies, they're lower on our lists, and we think they have much more bearish prospects going forward.
An interesting piece in the Wall Street Journal today described commercial real estate market on the precipice, really. It described investors yanking money from several enormous funds. Are you bullish in spite of that about the commercial sector?
We are, multifamily, industrial in particular.
But not necessarily office.
Not necessarily certain types of office. We actually think there are suburban office assets and buildings that are interesting. Life sciences is a niche that we've liked historically. And we think there's opportunities to convert some office buildings into residential. But big city office, we still think many landlords haven't adapted to the realities of this new, I want to say post-COVID, but almost post-COVID world.
Yeah, how does remote work factor in and change the outlook for office?
Well, really what it does is it changes how people think about space. It used to be how much density, how many people can you fit into a given space? Now it's how few people can you fit to give people that space that they need to feel safe and feel comfortable and the like. And so we're now focused on office buildings selectively where there are large floor plates, there's open space, there's good amenities. But for the most part, multifamily is what we focus on. And you brought up the redemptions point from those two big funds. We've always been focused on giving liquidity to investors. That was why I started the company. And so I think you're now seeing in times like this when individuals need flexibility, platforms that can offer that, such as ours, are the ones that will ultimately be able to serve the needs of individuals.
Yeah, you mentioned amenities. Never before have they been more important in terms of the things you have to provide to get people to offices. I want to close because you study such a broad spectrum, the residential sector. What is the impact you're seeing from increased Fed rates, increased mortgage rates? Basically, I'm going to do this. Some people think it's going to crash, a 20% drop. Others think we're just going to level out. We're still up 10% year over year in terms of median home prices. What do you see around the corner?
Look, I don't think this is an 08, 09. I don't think leverage is as out of control as it was at that time, and you'll see a huge crater. I do think there will be a correction. We've seen residential assets correct 10, 15, 20% down from where they were just months ago. And I think you'll continue to see a minimal decrease in the single family space over the next 3 to 6 months. And then I think you'll see
You're
a slight recovery.
Low single digits over
over the next 3 to 6 months, because I actually believe that banks were a lot more responsible this go around, and a lot of banks are pulling back. And so you're not seeing the same subprime issues you saw. And there still will be micro opportunities. That's the beauty of real estate. That's what we tell our clients all the time is even amidst these challenging macro times, there's always micro opportunities. And this is where a lot of wealth can be created if you pick the right sectors.
Got to be very, very selective.
Very
he
selective.
is Ryan Williams, the co-founder and CEO of Cadre. Good to see you, man.
Thank you.
Thanks for coming in studio.
Thank
Appreciate that. Tuesday felt a bit like doomsday when it comes to the economy. Why? Well, the big bank CEOs were out in force across different conferences, and one common thread emerged: pessimism. JP Morgan Chase CEO Jamie Dimon did not forecast a hurricane, but he does see, quote, inflation eroding everything, and says consumers have $500 billion in savings that will run out sometime mid-next year, adding that it may very well derail the economy and cause a mild or hard recession that people worry about. Dimon says customers are spending 10% more than in 2021. Goldman Sachs CEO David Solomon Quote, you have to assume the bumpy times are ahead, suggesting you have to be a little more cautious with your financial resources, with your sizing and footprint of the organization. It also suggested some layoffs could be ahead. Bank of America CEO Brian Moynihan says research suggests 3 quarters of negative growth next year and sees consumers spending more now than a year ago, but that rate of growth is slowing. And Shauna, it's just one of those days where you feel like you ought to start stuffing your lunch money down your pocket and saving for some rough times ahead. No one is speaking optimistically about what's ahead in 23. None of them.
Yeah, no, there certainly is a lot of caution. We heard it from a lot of the larger bank CEOs earlier today. Brian Moynihan, I want to take a look at Bank of America. That stock, Dave, having its worst day since March. And putting this in perspective with what we heard from Brian Moynihan earlier today, there's also some comments that he made about future hiring, or really lack thereof, saying that the company could potentially slow or will be slowing its hiring as fewer employees leave. There was also the CNBC report earlier this afternoon saying that the bank is cutting 2% of its global workforce. Investment banking fees, like you were saying, has taken a significant hit at Bank of America. They expect those investment banking fees to be down 50 to 60% in the current quarter. There was a little bit of optimism in his voice. If we do want to end on that upbeat note, investment banking pipeline, he's saying, should open. So should open. The investment banking division clearly taking a massive hit in 2022, saying that it should open. We don't exactly know when. I was searching for anything. I know you love all that positive news.
Well, I was happy to hear Ray Wong tell us yesterday that he thinks the IPO market will bounce back strong next year. We have seen no real glimpse of that, but he's confident in his talks with chief digital officers, at least across big technology. But why do we care so much? And it is obvious, but to remind you, because people like Diamond get such an accurate glimpse, not just at the macro, not just at companies, but a look at the consumer, how much they're saving, how much their credit balances are rising, how much their spending is going up or down. And it's hard to ignore all 5 big bank CEOs predicting some form of recession in 23.
It certainly is. And it's also, I want to bring up some of the comments that we heard about crypto, because that has been such a huge story in recent weeks. Now, Jamie Dimon also giving his take on where we stand. He called crypto tokens, quote, pet rocks. And drilling down a little bit more, he said, why do we allow this stuff to take place? This was all in an interview with CNBC earlier this morning. And back in September, he told lawmakers cryptocurrencies are decentralized Ponzi schemes. On the screen right now is actually an excerpt from what we heard from David Solomon. He's the CEO of Goldman Sachs. In a Wall Street Journal op-ed earlier this afternoon, he wrote that the excitement of the past weeks shouldn't distract us from the opportunity at hand. This is a bit of a different take. It is, though, very important to point out. David Solomon was talking about blockchain, whereas Jamie Dimon's comments were specifically referencing cryptocurrencies. But Solomon went on to say that under the guidance of a regulated financial institution like ours, blockchain innovations can flourish. So still some value in blockchains, at least what David Solomon has been saying. Jamie Dimon, it's important to point out, he has said that he does see value in blockchain in the past. A lot of that skepticism, though, specifically comes with the cryptocurrencies.
And just about any of those big bank CEOs tell you that same thing, that they see intrinsic long-term value in the blockchain, but almost none of them, at least at this point in time, will speak bullishly about crypto. And that analogy of pet rocks really stuck, because it's just who determines the value of it. It's built on no fundamentals. It's rising and falling on no real news. And I don't think we've truly seen the contagion, the true fallout of FTX, but each day we're learning a little bit more as companies feel a little bit more unstable. And now predictions that Bitcoin could crash and lose some 20 or 30% over the next year. No bullishness in that crypto space anywhere in sight. Pet rocks for tokens. Love that.
Not good if you're a crypto investor. Certainly it's been a very volatile several months. But going back to some of those calls out there, Standard Chartered saying that Bitcoin could fall to 5,000. So if they in fact are correct, we have a lot of downside to go until we potentially see things turning around.
It's election day in Georgia as voters head to the polls to cast their ballot in the state's Senate runoff election between incumbent Democrat Raphael Warnock and his Republican challenger Herschel Walker. And while Democrats have already secured enough seats to maintain their razor-thin majority, there is a lot at stake for both parties. Our next guest says that the outcome from the 2022 midterm election is a gridlocked Congress for the next 2 years, and a divided government usually reduces any prospects for major changes in economic policies. Well, with us now is Beth Ann Bovino, S&P Global Chief U.S. Economist. Welcome back to the show. So I first want to get your take, because a lot of people were wondering what was going to happen with the midterms, what this gridlock will actually mean when you have this high inflation background and a lot of economic policies that Biden still wants to push through.
Well, we see it as a gridlock Congress usually means less red tape. Businesses often like that, meaning that there won't be some major policy that could disturb what markets are looking for. However, at times like this, when we have unprecedented, uncharted territory, U.S. and at S&P Global ratings expectations is that we're going into a recession. You'd like to have some policy compromise. We see a gridlock Congress as something that means that not much will get done. Very few of the Biden proposals will likely get through. We think probably the Inflation Reduction Act will probably be the last for the next 2 years.
There is one key issue a lot of people have been looking at, and that is this fight over the debt ceiling. I mean, how significant a market risk do you see that as we look ahead to a potential fight between both sides?
Well, we think for them, we also believe that you need to have, let's say you've got the debt ceiling, and you also have the government shutdown. The U.S. government has been there before. They know how markets have responded to this, as well as the population at best, as well. And there is a sense that the frustration with the constituents on this back and forth among policymakers may have already sunk in. Of course, the threat is there. We can't ignore it. But let's hope that a government comes to its senses and backs away.
And obviously, we're still watching to see what the Fed does. They're not pivoting anytime soon. But when you have inflation this high, you also have a lot of stickiness still in the labor market. How much does that complicate the picture for next year?
Well, that's one of the reasons why we see a recession in our forecast. Although albeit it's a shallow recession, it's largely a story of a classic overheating of the U.S. economy. You have inflation coming down slightly, but it's still near that 40-year high, and about 2.5 times where the Fed would like it to be. And when we look at core inflation, that's one thing. The Fed has been incredibly aggressive. They say they're slowing down. I don't know if they're going to be able to. I think the worry is if they slow down too soon or too fast, they're going to just have to speed things up going forward. The concern that I have overall, and one of the reasons why we see inflation as being a challenge, and as you mentioned, sticky, we saw that in the jobs report. We saw wage gains up 5.1% on a year-over-year basis, something that the Fed does not want to see. But the worry, of course, is even with those big fat paychecks, in terms of when you adjust for inflation, it's in negative territory now for 20 straight months. So ultimately, nobody's happy, and the Fed needs to contain these pressures.
And Beth Ann, really quickly, I mean, that jobs number that we got last week certainly is kind of revived questions around, how significant that labor market or declines in the labor market need to be in order for inflation to cool down. You talk about the wage pressures there, but when we're talking about job losses, we got more reports today of other companies cutting. I mean, how much more of that are we likely to see in order to bring down the overall inflation front?
Well, there's two things that suggest in our mind that if the U.S. does go into recession as we expect, it'll likely be a shallow one. First, households and businesses are still holding on to, pretty relatively healthy savings. Now, this is an aggregate number, so it really depends where you are on the income spectrum, but that is one support. On to your point about what businesses will do, keep in mind that job openings they've come down, but they're still incredibly robust. So we would expect that businesses would first get rid of the jobs they may have available that they're trying to fill, put a freeze on those, and so that means they'll still be able to hold on to some to their workers. We do think that there is a challenge there, and we do think in our forecast we do see the unemployment rate climbing higher. We see it getting to around 5.5 or a little over 5.5%. So that does mean a squeeze for some workers. But overall, we see that some of the cushion in the economy so far suggests that we won't see certainly those ugly numbers of an inflation rate at 14 or even 15%. We're looking at 5.5 best.
S&P Global Chief U.S. Economist Beth Ann Bovino. Good to have you on the show today. Appreciate your time.
Thank you.
Stocks selling off today in fear that the Fed is going to stay aggressive and keep raising rates until the economy falls into a recession. Here to discuss where things stand from his point of view, we want to bring in Mark Zandi. He's Moody's Analytics chief economist. Mark, it's great to have you back here on Yahoo Finance. Let's talk about some of the recent data points that we got. We got the jobs report last Friday, the ISM services number out this morning. Wall Street Journal now reporting that 50 basis points could be on the table at the Fed's next two meetings. What's your big takeaway?
Well, I think the economy is resilient, but its growth rate is moderating slowly, but steadily. And I think it will continue to moderate under the weight of the higher interest rates. I think the Fed will continue to raise rates. The terminal rate get at least to 5%, but given the broader resilience in the economy, consumers, businesses, hiring, I think we can navigate through. We've got a fighting chance of navigating through the next 12, 18 months without actually going into recession. It'll be tricky. And, under any scenario, it's going to be a bit uncomfortable. But I think recession is not inevitable.
Primary concern of that latest jobs number being wage growth. How concerned were you?
Yeah, I mean, if I were going to write it on a piece of paper and say, hey, what would I like to see? It wouldn't have been 5%-ish. That's kind of the underlying rate of wage growth as measured by average hourly earnings in the report. We need something closer to 3.5%. But I think all the trend lines suggest we're headed in that direction. I mean, job growth is slowing quite significantly. Underlying job growth is 250K per month. We were at 600K per month at the start of the year. Other indicators suggest that we're going to see further slowing in job growth. Hours worked decline. The number of people working in the temp help industry weakened. That's a leading indicator of future job creation. The other survey of employment, the household survey, I mean, all these numbers, the 250Ks survey businesses, but you look at the household survey, another window on what's going on in the job market, that's been meaningfully weaker, and that may be also a leading indicator. So job growth is steadily slowing. And the other thing I'd point out is labor force growth, labor supply is okay. It's not too bad. Unemployment stopped declining. The employment to population ratio has stopped rising. So all the trend lines kind of suggest that we're going to get to a place where things cool off and wage growth begins to moderate. Not next month, not next quarter, but by this time next year.
Margaret, I know you're also keeping a close eye on gas prices, how that's factoring into inflation. Another important thing to keep an eye on when we're talking about wage growth and its effect on inflation. I guess talk to us just about how important of a factor that is, and especially to how consumers are currently feeling about inflation.
Yeah, that's a great point, Shauna. So I do think that one of the key reasons why wages took off here beginning this time last year, was the jump in oil prices, gasoline prices related to the Russian invasion of Ukraine. And gasoline prices, oil prices, they play a central role in people's thinking about inflation. I mean, it's a price that they observe every day that they go to work. They pay it at the pump once a week. So they see it, they feel it. It really is what's key to driving inflation expectations. So when oil gasoline prices surged to record highs, I mean, back in June of this year, we were paying $5 for a gallon of regular unleaded, a record high. I think that's when workers said, hey, Mr. Employer, you need to pay me more to compensate. And that's why we've seen this inflation metastasize. But now with oil prices in, gasoline prices coming down, we're at $3.50 for a gallon of regular unleaded, headed lower. If nothing disturbs that, obviously a lot of risk around that, but if nothing does, then I think wage demands will moderate as people's consumers' inflation expectations moderate along with the lower oil prices, gasoline prices.
Of course, you have been watching the housing market, the first indicator of Fed success or lack thereof. Do you see prices leveling out? Or are we talking about a major 20% type correction some are still predicting?
Yeah, somewhere in between, David. So not 0, not 20. If you told me down 10, peak to trough, that sounds about right to me. In the context of mortgage rates that are sitting, fixed mortgage rates are 6.5%-ish. If we hang there, and that feels like we will, that's hammered affordability and crushed demand. Home sales are way off. So I do expect prices to weaken here. I don't expect them to go down 20 or collapse because in part, I don't think we're going into recession, in part because the borrower, the quality of the borrower since the financial crisis is actually quite good. Credit scores have been very high, and they're getting, plain vanilla 30-year, 15-year rate mortgages, nothing weird or exotic like what we saw before the financial crisis, 2 years subprime ARMs, neg am loans, that kind of thing. So I think we're in a spot where we are going to see a correction in price, just because we have to, the housing market has to restore affordability. The market's just not affordable at this point for most potential buyers. But I don't think we see a crash, which would be, kind of a 20% decline.
Mark, another important indicator that many on the street closely follow, the CEO optimism survey from the Business Roundtable. That was out this morning, showing that optimism is declining. There certainly is a bit more pessimism when you're taking a look at what CEO outlook is into next year, but it's not falling off a cliff. I guess your broad takeaway on that, and just in terms of what that signals to you.
Yeah, it's bizarre, isn't it? I mean, I've seen many business cycles, many recessions. I've never seen kind of this broad-based pessimism, particularly among CEOs of companies. They're generally, glass half full kind of people, looking on the upside. So it is, surprising. One possible takeaway from that, though, is you actually need business people to be cautious for the economy to slow sufficiently to quell the inflationary pressures. So if businesses run by CEOs that are very nervous about the economic outlook begin to pull back on investment and hiring, and that's kind of sort of what we need. So that may help, forestall recession. The other thing I'd say is the key to recession, though, and at the end of the day, a recession is a loss of faith. It's business people losing faith that they can sell whatever they produce, and they start cutting jobs. It's a loss of faith of consumers that they'll hold on to their job and they stop spending. So it's really the change in sentiment that really matters. And people can feel blue and not great and ugly, but if that doesn't collapse, then I think we can avoid an economic downturn. But if sentiment really starts falling very rapidly, that means people are losing faith, business people, consumers are losing faith, and that would be a tell that we in fact are going into recession in the not too distant future.
As for that consumer market, it's been another confusing dynamic where savings continue to plummet and credit balances continue to skyrocket, increasing more than they have in some 20 years. How long can this dynamic hold up?
A while. That decline in saving rate represents all that extra savings that people did during the pandemic. I mean, they're drawing that down now because of the high inflation, but they have significant amounts of cash, sitting in the bank account that they saved during the teeth of the pandemic, and they're now using it. So the saving rate, the measured saving rate is low, but they're able to supplement their income with their purchasing power with that excess savings. So that's a good thing. Of course, low-income households, that's not the case. They have drawn down their excess saving and then some, and now they are turning to credit cards and unsecured personal loans to help supplement their income. And that can't continue for very long. At some point, they're going to be tapped out with that. But at the end of the day, the folks in the top third of the distribution of income account for over 2/3 of the consumer spending. So it's not great. The economy is not going to thrive. Again, it's not going to be, it's going to be a struggle over the next 12, 18 months, but the economy can continue to move forward as long as that top third of the distribution keeps spending. And right now, they got a ton of cash.
Because that's a glimmer of hope there. Mark Zandi, Moody's Analytics chief economist. Always great to have you. Thanks so much for joining us this afternoon. And that wraps up what was a very down day on Wall Street. I guess a glimmer of hope there, closing off the lows of the day just slightly. Dow off 483 points, S&P off nearly 2%. The NASDAQ, the worst performer of the three major averages, off just about 2%. In terms of the sector action, all 11 of the S&P sectors trading to the downside. Consumer discretionary, energy, both of those sectors off just over 3% today. Let's bring in Jeff Klingelhofer. He's co-head of investments at Thornburg Investment Management. We also have David Scranton, Sound Income Strategies founder and CEO. Dave, let me start with you just in terms of the selling pressure that we saw this week, the losses being led by, the losses being led by energy and consumer discretionary. Just your takeaway from some of the concern that's clearly on the street right now.
Well, I think we just, interest rates came down a lot based upon some words from Jerome Powell just recently. and maybe they came down too far. Maybe it was a little too much short-term optimism. At the end of the day, Fed President Jerome Powell said he wanted to raise rates another 1.25%. And if he increases by 50 bips versus 75 on December 14th, it's really not that big of a difference. And when you look at that, we've had a flip now where the 10-year yield is actually below the federal funds rate. That's a concern about recession. That's why you see consumer discretionary getting hurt. So there's, again, we're going to be in this market where it's volatile. It's going to continue to be volatile for a while. We had a little overreaction to the upside, and of course, now we're getting a pullback.
And Jeff, your reaction to today's moves, and in particular, that move down in oil despite all the news overseas, the Russian price cap, et cetera, the EU sanctions as well.
Yeah, it's a market that we're watching closely because it's incredibly important because it's direct correlation with inflation, which of course is what Federal Reserve in the United States and other central banks globally are watching, right? It's the first order effect. But what we see is this teeter-totter between we have to see growth slow in order to get inflation down, and we're seeing that reflected in the price of oil. We are seeing growth slowing, but we can't have it slow so much that we actually get an outright recession. And so similar to the other guests, we look forward into 2023. We expect significantly heightened volatility and really a teeter-totter between growth and inflation.
So, Jeff, given that significant heightened volatility, the teeter-totter that you're expecting to see, what should investors be doing right now? Is it the smartest then just to stay on the sidelines?
No, I don't think staying on the sidelines is the right move today. The beauty of where we find ourselves today is we finally unwound much of the challenge that investors faced throughout the previous decade of exceptionally low and accommodative monetary policy. So today what we're looking at, although we think the 10-year Treasury should be slightly higher than where it is, today fixed income serves as ballast to equity, which is actually perfect for investors, right? Thus far, 2022 has been marked by an extreme standout in terms of the difficulty from asset allocation. But for investors today, we think having some equity allocation in relatively inexpensive sectors, particularly some of the income-producing sectors within the international space, as well as ballast within fixed income. Really like the front-end U.S. consumer focus within the securitized market in particular. And actually, we like tips here as well.
David, what are your thoughts on that?
I agree with Jeff as far as fixed income is concerned. Of course, it depends upon where you are in your life cycle and how much risk you can afford to take, time horizon, and so on. But this is the first time we've seen fixed income yields this high, and certainly over a decade and a half. There was a long period of time where even if you mentioned the words fixed income, people would look at you like you were crazy, right? But not anymore. If you have a longer time horizon, you're going to be on the equity side. This is truly a stock picker's market. And it's kind of hard to determine sectors per se. But again, it's more of a fundamental bottoms-up approach. It's the days of indexing and mutual funds really are over for the most part, at least for the next few months, until we bottom out and we declare a recession and then we start to get into the recovery phase. For now, a stock picker's market, and I like higher dividend value plays.
David, I'm curious there just in terms of whether we bottom out, when exactly that would be, in terms of what you're watching to indicate that we have seen a bottom. What are some of those factors?
I think we have to get to a point where we actually determine that there is a recession. I personally believe that we've gone far enough now, we will see a recession because it takes time for the effects of these interest rate hikes to work through the system. So even if they were to give us a 25 basis point jump in December and then one on the next FOMC meeting, I think the recession is still inevitable. But once that gets announced and the Fed starts the reverse course, then we can look forward into the recovery, and then it's a whole different ballgame.
Jeff, do you see a recession as inevitable?
We do see a recession as inevitable at this point. The question is really the depth of the recession. And what we're looking for in order to really get the magnitude of that is a very close eye on the consumer in particular, where we look at credit card remits on a monthly basis and the consumer remains incredibly strong. What we've seen is the savings rate dip to one of the lowest in the entirety of the time series, right? Where the consumer is still willing to dip into savings, spend COVID stimulus to support consumption. We need to see that begin to bottom. We need to see the savings rate begin to come back up. And ultimately, we need to see the bottoming of unemployment, which we haven't even begun to see, and really is what Chairman Powell has told us time and time again. They need to see a further weakening in the labor market, which we haven't even begun to see today.
David, what about outside the U.S. in terms of any opportunity overseas? Morgan Stanley out saying that they're taking another look at some Chinese-related stocks. Are you seeing any reason to buy some of those beaten-down names?
I personally am not ready to go to China yet, per se. However, with the dollar being as strong as it is today, one could certainly make the argument for making some international purchases. Now, you know, the counter argument is, oh gosh, we're going to have a recession. It's going to cover most of the globe. And of course, the flight to quality usually is the U.S. bond, and therefore pushing the dollar up even further. But you know, I don't see that the dollar has that much more upside potential. So yes, looking at international, if you know what you're doing, it could be the right time.
All right, we'll leave it there. David Scranton, Jeff Klingelhofer, appreciate you both being here. Thanks so much.
Brian says he had a chance to speak with the president of the New York Stock Exchange, Lynn Martin. She weighed in on the IPO landscape for the year and beyond, upcoming tech initiatives for the stock exchange as well.
It's been a really volatile year, as you point out, for investors. But, you know, one of the things I'm most proud of is how our systems have performed. You know, we're seeing record response times. We're processing 500 billion messages a day incoming to the New York Stock Exchange. And we're seeing average response times of 30 microseconds. So couldn't be prouder of our team. We have done what our job is to do in times like this, operate the most transparent markets in the world in the most efficient manner possible.
You have a really extensive tech background. How have you invested in technology this year to make things just work so seamlessly in a year where we have seen massive volatility spikes?
Yeah, I mean, it's something that I monitor quite closely along with my team. You know, how are we doing in terms of message rates? Do we need to add more capacity? I'm really proud of the fact that we were able to complete the migration for one of our options platforms to our state-of-the-art pillar system. So given the increase in messaging we've seen, couldn't be happier with the way the year's gone.
Lots more to talk about, of course, markets, deals, you name it. But as you look towards next year, where are you focused in terms of tech? What's your one or two biggest initiatives?
I continue to be focused on making sure that the NYSE operates the most efficient markets possible. I'm really, continuing to talk to those companies who are looking to go public. Once the volatility calms down in the market, the pipeline continues to be incredibly strong. So we're really excited about the fact that when the market calms down a bit, when there's a bit more certainty as to where the Fed's going and other macro factors are headed, I think we'll have a successful spat of IPOs.
In terms of IPOs, what does that pipeline look like? Big companies, smaller companies? Take us through it.
It's pretty much runs the gamut. You've got tech companies, you've got consumer companies, you've got healthcare companies, all looking to go public, all looking to tap the public markets. This year has been a muted year in terms of IPOs. IPOs are down about 85% versus last year. I like to refer to it as the other tail.
You said that number. I wasn't going to say it, but it's been a tough year.
It's been a tough year in terms of companies coming to market, but the pipeline is tremendous. The value of the U.S. public market currency has never been stronger. It's just a question of when.
What are companies waiting for? Is it a Fed pivot? Is it stock market just not having these volatile spikes? Is there one thing you hear when you talk to folks?
Volatility. Volatility to come down. The benchmark that I always look at, the VIX. If the VIX is above 20, it's a really volatile period of time. You really want the VIX to ultimately be below 20. This year it's been kind of around 30. So that's really what is worrying private company CEOs.
When do you see the deal, that backlog loosening up? Is it more of a second half event, or we might start to see things pick up in the middle of next year?
It's hard to say. It also depends on the profile of the company. We at the NYSE had the largest IPO of the year, Corebridge, which went live in the public market September 15th of this year, raised $1.7 billion in capital, priced in its range, and has still continued to trade around its IPO price. So it's been a really successful IPO. It just depends on the type of company. I can't really answer the question.
There's a whole generation of investors that have not grown up with a Fed hiking cycle. This has been a strange 2022, and it might be a strange 2023 in that regard. As the Fed continues to do what it does, how do you think the markets might respond?
I think the markets will continue to try to find their footing. The one thing markets don't like is to be surprised. I think we've all seen that, whether it's the Fed not doing what it's going to say, the Fed putting out the additional increases, increasing the target rate, whatever the case may be. Markets don't like when they're surprised. So that's what's really been causing the volatility.
You've also been you've been talking recently about the ESG and disclosures. Where are you with that in terms of companies looking to come public?
Yeah, it's actually one of the primary topics that I talk to both our existing public company CEOs and private company CEOs. Our position is that we provide tools, we provide ESG tools that allow customers to meet whatever ESG mandates they're looking to achieve. For example, diversity. Diversity is an area that we feel very strongly about. We have the Board Advisory Council, more than 400 diverse candidates that are board ready. So that's an area we've had tremendous amount of success, both with public and private companies.
Are some of these ESG requirements or potential requirements, are they too stringent? Should somebody not be investing in a company because they make oil?
I think it is down to whatever your investment strategy is. And it's, in my mind, comes down to disclosures. In terms of the individual sectors, the oil industry is one that's near and dear to my heart, coming from the ICE side of the business. The oil industry has done a tremendous amount of trying to move from brown to green in a responsible fashion. And what I mean by that is they're trying to do it without deeply affecting the consumer's pocketbook. So I have a tremendous amount of respect for that sector in particular.
You're, I think, coming up on the 1-year mark since you were announced as the president of the New York Stock Exchange. What has that first year been like for you?
It's been an interesting year, a year filled with surprises. I didn't know there was going to be a war between Ukraine and Russia. I didn't know there was going to be record inflation and record volatility throughout the year, but it's been a tremendous year. We have the greatest community of CEOs. I've really enjoyed getting to know the CEOs of our NYSE community and figuring out how to better serve them.
How have you navigated this environment as a leader? How are you different today compared to 12 months ago?
I actually come back to one of my core principles, and one of my core beliefs is that you can never over-communicate. And we've taken a very deliberate step at NYSE to be very public, to be out there, to be on as many events as possible, to really give the market some calmness, to tell the market what we're seeing, since we're seeing all different sides of the equation on a variety of different issues.
Walking around the New York Stock Exchange floor, there's so much history in here, but it feels a little different. There's new media booths in here. There's just something else in here. Talk to us about reinventing the floor. What's the state of the New York Stock Exchange trading floor?
Well, the floor, especially in the volatile conditions, the traditional role of the floor has never been more relevant. And that's something that resonates with people we're talking to that are private companies looking to come public. The role of the DMMs here is to really mitigate the volatility in the market. And we've proven through data that our market model has caused NYSE listed stocks to trade with less volatility, the open and the close, as well as throughout the course of the day. That's money in the hands of our company's CEOs when they think about share buybacks and those types of issues.
That was New York Stock Exchange President Lynn Martin with our own Ryan Sazi.